host, right? Okay. Stephanie, you made me a co-host, right?
Yep.
Okay, great. Okay, well, go ahead, Stephanie. You can start it off and then I'll take it from there.
Okay. Well, good morning, everyone. Happy snowy. Great day. Great choice that you selected to be with us today. We're very excited. Just a couple quick housekeeping things. You should have received the PowerPoint slides from me. Let me know if you didn't. I'm happy to resend those over to you. David is great. He makes this as interactive as possible. So you can keep your camera on and your mic. That would be great. As you just noticed, we are recording. So I'll send you that link in case you have to miss a couple minutes or anything like that. David will be going over the schedule. So he works in breaks and lunch. I know it's a long day to sit for training. So, but you're in really good hands with David. He's one of our favorite instructors. We receive wonderful feedback about you, David. A couple things about MBA. We've got a super busy spring. We're very excited. We have our BEST conference, our Bankers Education Summit trade show coming up April 12 to 14 in Traverse City. 40 breakout sessions, so tons of education there and a trade show. And then following that, we've got our Rising Leaders Day here in Lansing, and that's followed by a Bankers Day at the Capitol. So you can come for both of those if you're interested, or send your team. And then after that, we've got our BSA AML school, May 11 and 12. And then the next week, we have Women in Banking Day, May 18th. So, and then of course, our general banking school, the Perry Schools, is in May as well. So lots of stuff coming up, but if there's any training needs that you have that I can help you out with, please let me know. So we're very excited to have you on today. Like you mentioned. Right, so let me tell you a little bit about David. And sorry, my computer just went to sleep, but David Osborne is the founder of Osborne and Associates LLC, a business training and contract CFO firm that provides training and speeches for bankers, CPAs, credit managers, attorneys, and business owners across the country. He has an extensive professional background with over 30 years, including 20 years as a business trainer, contract CFO, 16 years as a bank commercial lender, including the position of VP Senior Banking Officer. And then in his downtime, which it doesn't sound like he ever has any, he's also a college professor for over 30 years. And as David mentioned, he's joining us from Nevada today, and it's cold there. 30s? Oh, yeah. Wow.
Yeah.
Yeah. So
well, thank you, Stephanie, and welcome everyone to today's session. My name is David Osborne, and today's session is Introduction to Consumer Lending. Now, we have a small group, but we're going to be interactive, as was mentioned. And I want to emphasize, this is a live interactive class, mirror image, as if we were all together at the MBA, Michigan Bankers Association, in Lansing, in Stephanie's office there. Conference room, there's a nice training room, and I've trained there extensively over the years, and it's great to be there. But when we have a smaller group, and of course during the era of the COVID, more of this webinar Zoom type meeting. Now, to begin with, I'd like to have introductions, and we've got Michelle and Kirk on, and hopefully we have our third person join us shortly. And what I'd recommend you do is keep your phones or keep your mic muted, but I will call out your name and periodically, and we'll interact. And if you have questions, don't hesitate to unmute yourself, stop me, ask, can you clarify this? Can you say that one again? Or we've had this situation in our bank recently, and boy, this ties into this concept, and just don't hesitate to reach out and to be interactive, if you will. We're going to start with Michelle. We're going to like to have you give us 4 items. Number 1 is your name. Number 2, what bank are you with? Number 3, specifically, what do you do in the bank? Not your title per se, but your function in the bank as of right now. And number 4, and you'll love this, Michelle, how far are you distance wise from roughly, or hours, we'll use hours from Lansing. So Lansing, will use Lansing as the where the headquarters of the Michigan Bankers Association is. So how many hours and what direction? So what direction roughly, and how many hour drive? So Michelle, go ahead if you would, please.
All right, can you hear me? I got my
Oh,
mute off.
yes.
Good. Okay, so my name is Michelle Shaw. I work at Bayport State Bank. I am a loan processor as well as the trainer for the bank. We are about 4 hours, which is about 130, according to the distance between cities, I'm 136 miles northeast of Lansing.
Okay, great. And you're a loan processor and trainer at the bank, right?
Yes, I do a little bit of everything. I come with an experience where I've been on the deposit side, the operation side, and now I'm on the lending side. So,
Okay.
and I work for a commercial and ag lender who does very few consumer loans, but every once in a while he throws in a consumer loan for one of his commercial customers. So I wanted to know more because there's a big difference in between commercial lending and consumer lending.
You bet. Excellent. Thank you. And how many years in banking total? And let me ask another question.
About 20 years.
Okay, great. About 20 years. Thank you for that. And Kirk, I can see Kirk's on with us. Kirk, can you give us an introduction, please?
Absolutely, sir. My name is Kirk King. I don't work at a bank. I work at a CRM company that provides CRM services to banks. I've been a member of the MBA since like 2010, and I just finally had a little bit of breathing room so I could start joining some of these webinars.
Great. And help me understand, what is CRM?
It stands for Customer Relationship Management. We're a software company and we have built-in marketing specific for the banking industry.
Okay.
And my function is like chief bottle washer at Continuity Programs, which means I've been the owner of it since 2010.
Okay, great. So you provide marketing services for the bank. Is that for banks, right?
Software with built-in marketing. Yeah. So we have about 160 banks nationwide that use our software. Okay.
And it's primarily for marketing purposes, right?
It's for mortgage and consumer lending.
Oh, okay. So actually mortgage and consumer lending, pardon me, as far as the actual underwriting, processing, and so forth. Is that right? Okay, great. And where are you located, Kirk?
I'm about an hour from Lansing, and Lansing would be northwest of me. So I'm about 30 minutes north of University of Michigan, about 45 minutes from Detroit.
Okay, so you're near the in that area. You said about an hour from Lansing, right? Okay, great. Let me just jot that down. Okay, has anyone else joined us? Don't see anyone else in the system. Okay, let's go ahead and proceed forward then. If you'll turn with me, and you should have the PowerPoint, pardon me, the PowerPoint presentation. So if you'll turn that to page number 2, here's a bio on myself, and Stephanie, our administrator, has reviewed that with us already, but I'm a business trainer, a contract CFO, and a college professor. And I'm also a former banker. Pardon me, I worked at Bank of America for about 9 years, but also worked at 2 community banks. Now, Kirk, I know you're not in the bank, but you support the banks, like you said, with mortgage, consumer lending. Were you in a bank or not, career-wise? Were you ever in a bank?
I never worked for a bank.
Okay. So I'm just curious, before you started your company, what did you do? What was in your kind of from a career standpoint?
When I resigned from Borg Warner Automotive, so I was responsible for sales for North America and Europe. Before that, I was an advanced development engineer at Delphi. And before that, I was also an advanced development engineer at United Technology.
Okay. So you've
So
got
I came from an engineering background. Yeah,
okay.
my undergrad's in mechanical engineering. My master's is in business, but I have a focus in finance.
Okay. Great. Good. Thank you for that. I'm based in Las Vegas, as was mentioned, and I do travel, and I do emphasize that even though when the pandemic first hit, I was off the road and doing webinars exclusively. But over the last several months, I've been getting out on the road some, not nearly like before, but definitely getting back out ground-based. I'll actually be in Tennessee in about a week and a half or so, doing a ground-based session at a big banking school and so forth. So I'm starting to get back out on the road a little bit, but not nearly like it was before the pandemic. You'll notice my email address, dlosborn@cox.net. My last name is unusual. Pardon me, instead of the more common Osborne with an ORN, it's Osborne with the URN. And if you've got a highlighter, I encourage you to, number one, if you haven't printed out the slides, I'd print out a hard copy so you can take some notes right on the slides, or you may want to do it even if you can do it on your laptop or your computer. But I would grab your highlighter and highlight my email address, if you would please, dlosborn@cox.net. Now, once again, today we're going to do live interactive, but a month from now, you have a question on a consumer loan. Michelle, for example, you may work on a few consumer loans, or Kirk, if you've got a question relative to consumer lending, relative to supporting your bank clients, don't hesitate, reach out to me, send me an email, please. I do emphasize, number one, I keep everything confidential, whatever you would send me. Questions, what have you. Number two, I don't charge for this. I consider it as an extension of today's session. And number three, I do receive emails regularly, and from individuals that have either attended a webinar or even a ground-based session. I've even had people in my classes, believe it or not, that I've interacted on both. For example, oftentimes when I walk into a ground-based session today, I'll have people say, wait a minute, didn't you just provide a webinar last week at such and such? I go, yes, I was on that with you. And of course, I'm like, oh, okay. I do these full day sessions regularly, but also I do quite a few in any given week, an hour and a half to 2 hour, what I call kind of a straight up webinar, where it's just a straight lecture, very little interaction with the audience, if any. And then of course they take a few notes and we're done, and that's it. But today's session, of course, as you can see, is live interactive, if you will. So different than the hour and a half to 2 hour, kind of a more traditional webinar per se versus a full day class. But I do those as well on a regular basis. Now, if you turn forward with me, page number 3. Now, before we go into the kind of the outline or the agenda for today's session, just a little bit of housekeeping. As Stephanie mentioned or alluded to, we will take breaks. We'll take 2 5-minute breaks in the morning. We'll take 2 5-minute breaks in the afternoon. Pardon me, and we'll take a half-hour lunch right around 12 noon your time. Now, we're 3 hours difference. You're in Eastern time, of course, and I'm in Pacific. The entire state of Nevada, where I'm based, is Pacific, the same as California. But we'll take that break, and then once again, a couple breaks in the afternoon as well. Also, by way of kind of a little housekeeping, we will do, and I'll be asking you individual questions But periodically, pardon me, we will also be doing what I call class shout outs. A class shout out is where I'll just ask the question, and then both of you will unmute. You'll all unmute your lines and just shout out or blurt out the answer. Now, the class shout outs, pardon me, are primarily yes or no questions. Real basic, is it yes or is it no? Whereas when I call out your name, it would be to ask your feedback and to actually have some dialogue, if you will. Class shout outs, once again, usually just yes or no. The individual is more a dialogue format. Okay, so we've done our formatting and we've done our kind of our housekeeping. Now, you can see here on page number 3, and it continues on to page number 4. This is the outline of today's presentation. You can see the very top here, page number 3, consumer lending function, just kind of an introduction, the history of consumer lending, competitors, marketing, and so forth. And we're going to hit this marketing up front. And you're going like, well, why are we doing marketing up front? Why don't we jump right into the technical, the underwriting of the consumer loan or line of credit? Well, it's because the truth of the matter is, unless you have enough volume coming through the front door to your bank, or in your case, Kirk, clients coming through other banks where you're supporting the mortgage and consumer lending process. And let me ask, Kirk, just for my benefit, do you underwrite for these banks, or is it software that they use in their underwriting? I was just curious, how do you interact with the banks?
That's a great question, David. So we have a software. It's called My CRM Dashboard, and it's software as a service, which means it's in one of the big clouds in the data centers.
Okay.
We pull the data directly out of the cores, the core processing systems, as well as out of the LOS systems, the loan origination software.
Okay.
So we pull like consumer data out of the core and out of the LOSs. And then the communication automatically goes out from the banks, from the different people at the banks. So like a mortgage lender, or a auto loan lender, or a consumer, mortgage, various different people, branch managers, that kind of stuff. So the information actually goes from a person at the bank to the consumer automatically. Like it's a self-driving system. So we have to API into the LOS, we have to API into the cores, and then our system kind of just lays on top, and it pulls all the data out, and it automatically sends out all the communication and all the marketing that the banks would like to do if they were like JP Morgan Chase.
Got it. If they were a large bank, right?
Right. So our customers are usually regional banks, or banks with at least 10 mortgage loan officers. Those are usually our best customers.
Okay. And you're sending out the marketing information for those regional banks. Okay.
Correct. Like emails and mailers and thank you cards and postcards and flyers and brochures and all that stuff goes out like automatically. If they're running specials on auto loans, mailers might go out. If they get a new mortgage customer, we would send out like surveys to the mortgage customer. We might also do mailers around that, the consumer that got the mortgage. So there's a lot of different things that happen, but our value prop is that it just runs automatically, self-driving.
Yeah. Okay, good. And Michelle, in your world, you do multiple items within the bank. How big is your bank, Michelle?
It's a very, very small bank. We have 30 employees.
Okay.
We have 5 lenders, of which 3 of the 5 do all lending: ag, commercial, consumer, and mortgage.
Wow, the whole bit.
One specializes in your ag and commercial. Actually, 2 of them really specialize in the ag and commercial. One is a specific mortgage loan officer. And with it being such a small business, we all do like so many things. Like I told you, my 2 primary roles.
Yeah.
I do a lot more because we just have to with the size of our facility.
Okay.
Yeah.
Including, I dare say, marketing as well, right?
We do a lot of our own market. We do have a marketing person that it drives, radio ads and billboards and things like that. But the rest of it is word of mouth. We're from a small community, and we're a lot of it's word of mouth, to be honest with you, or Facebook posts or something like that.
Okay, good. And then of course, Kirk, yours is a marketing, but it's from a whole different scale, regional bank, all the, like you said, the flyers and so forth, postcards, mailers, all of that, supporting the lending process. Okay.
I was writing all that stuff down. He was saying, I'm like, oh, that's a really great idea. And then when he told me he works with regional banks, I kind of giggled and I kind of went, okay.
Kirk, let me ask you, Kirk, do you work with any smaller community banks, or is it all regional banks and above?
No, we do work with community banks, but they have to have at least 10 mortgage loan officers.
Yeah.
Got it.
I think I've got maybe 5 community banks that have less than 10 loan officers, mortgage loan officers.
Yeah.
But most of my banks are large community banks or regional banks.
Right.
Got it.
But I don't even call on the top 10. Like, they're not my customer.
Yeah. Okay. Got it. Okay. Under section number 2, we're going to talk the 5 C's of credit. So we're going to mark it up front, because the truth of the matter is the bank has to have a certain volume of loans coming through the front door, or the loan portfolio will not be vibrant. The consumer loan portfolio, and this applies to even mortgage loan portfolio and commercial loan portfolio. Under the section 3 is within the 5 C's of credit, we're going to be making credit decisions or using this model, the 5 C's of credit. Under the next section, the lending process, the consumer lending process, which includes structuring, supporting. And then if you'll turn with me to page number 4, documenting the loan. Now, in between, of course, the structure and the support, we have loan approval. So then we go into our loan documentation. Michelle, do you deal with documentation issues much or not?
It seems like daily.
Okay.
There's something that, customers are unique birds and they like to be creative. And as a lender, our lenders want to do what they can to satisfy it. But when you're talking consumer, there's so many questions that come up on a daily basis.
You bet.
That's
Kirk,
why I'm taking this class.
You bet. Kirk, and we're going to talk in depth on documentation issues on the consumer loans. Kirk, in your world, you don't do documentation. You're more on the front end, right?
Correct.
Okay, good. Closing the loan, we're going to talk about, and this is part of the consumer loan process from A to Z. Monitoring the consumer loan, Then on the back end, we're going to, meaning the back end of the process, we're going to talk loan compliance, including collections. So I would add right next to loan compliance, we're going to do a section on collections, which I think you'll find interesting. Because in the A to Z of the process, typically we say, well, the last of the process is the monitoring of the loan. Well, but a certain percentage of the consumer loans will go bad, even if we're in a very strong economy. Today, we have a real mixed economy. Some aspects strong, some aspects weak. We've got inflation. We've got the war in Ukraine. We've got We've got supply chain issues. We're still coming out of in many aspects, coming out of the pandemic, depending on what state you're in, the masks are being lifted and so forth. It's a lot of different economic, pressures on the economy. But even in a strong economy, we're going to have some defaults. People die, people get divorced, people have personal financial problems because of multiple reasons, medical reasons, you name it. Then under section number 11, pardon me, we're going to look at 6 case studies, mini case studies towards the end of today's presentation. The mini case studies are what if scenarios. The first 3 are, pardon me, the first 3 are new loan request. And I'm going to have you take the position as if you are the loan officer and make the decision, yes or no, would you approve this loan? And there's 3 of these. And then the last 3 mini case studies are existing consumer loans with problems. All 3 of them have got real issues. And I'm going to have you make a decision. Do you work with the client? Their actual request to modify the loan or what have you? And so I'm going to have you make the decision on those as well. 3 up front, brand new request, 3 existing loans that become challenging. And you're going to look at these like, wow, I'm making the decision. Yes, because we're going to use those 6 case studies to really summarize essentially the entire class. Then we'll talk just a brief under section number 12, a few little miscellaneous ending comments or concepts, and then conclude at the end of the session. Now, because we have a small group, once again, we typically will go till 3 o'clock your time, but because we have such a small class, we'll get a discount at the end of the day, the end of the session. And like I said, tongue in cheek, it is Friday, so we'll have that as well. But we will cover all this material in depth, as you'll see. Now let's move forward. If you'll turn with me to page number 5. Now we're going to go into our first section. Okay, consumer lending function within the bank. We have 3 main areas of lending: consumer, residential or mortgage, and commercial. So I'd put mortgage right next to residential. Mortgage, and Kirk, that's, boy, like you, a lot of your clients, you've got those mortgage lenders. Boy, that you kind of tap into that for all the marketing support and so forth. And Michelle, you've got mortgage lenders, like you mentioned, in your bank as well. But these are the 3 main areas of bank lending. Today, we'll emphasize consumer. Now, as I mentioned, I'm a former commercial lender for many years, managed a commercial lending team at one point in time, worked at Bank of America, worked at 2 community banks and so forth. But before I was a commercial lender, the first bank I was at, which was actually in Southern California, I was a consumer lender, worked in 2 different consumer lending departments. One, we emphasized, auto loans, home equity lines, and so forth. The second one, believe it or not, we emphasized RV loans, recreational vehicle loans. Why? And we did these, literally did RV loans every single day, all day long. The reason why? We had a major RV manufacturer right down the street from the bank, just a mile or 2 from the bank. And it was funny because I thought it was a contractual relationship between the RV manufacturer and our bank. And I asked my boss once, and she goes, "Oh, no, it's just we've had it set up for so many years. They just send us, they just basically point right up the street, just go right up the street a mile or so, Go right in there, boom. They'll set you up, and just like every day. It was literally clockwork. 3, 4, 5 customers a day. Besides just, some miscellaneous auto loans and a few others. But these RVs, and they were sizable RVs, they were pretty sizable loans as well. Consumer lending defined. You put off to the side of part A, we define consumer lending as follows. It is lending to an individual or couple for personal use outside of residential or mortgage. So it's of course not commercial or business. So it's an individual or couple for a consumer purpose, individual use, so to speak. We're going to use an example today of Bob and Sue. Bob and Sue. Okay. Imaginary couple. They live, we're just going to say they live Lansing area. Okay. Just as a point of reference. Okay. Bob and Sue are classic consumer borrowers. Now, they could have 1, 2, 3, 4, any of these. These are the categories of consumer loans. Installment loans, closed end. I'd put right below that in your notes, please, P&I, principal and interest, P&I. They're set monthly payments. You can see the examples: an auto loan, $500 a month, an RV loan, $750 a month payment, recreational vehicle loan, a second mortgage deed. You notice I said trust deed. For whatever it's worth, primarily east of the Mississippi, we call it a mortgage deed. Okay. And Michelle, in your world, do you call it a mortgage deed? Meaning that type of a loan.
We just call it a mortgage.
Or even just a mortgage.
Or first, it's a first place or
first mortgage
second,
or second mortgage.
Yep,
okay.
That's the way we refer to it. Yep.
Good. Now, for whatever's worth, west of the Mississippi, it's primarily called a trust deed or deed of trust. But in this case, it's a second on the home, typically. The first mortgage is that primary loan. This, of course, is a second. And sometimes lenders just call it, oh, it's a second. They don't even say second mortgage. They just say, oh, it's a second. Section number 2, this next category of consumer loan, pardon me, revolving line, open-ended. Right below that, I'd put interest only. Interest only. Okay. Now, you can see the classic example is the HELOC, home equity line of credit. Kirk, in your world, do you have, you're mainly a lot of mortgage lenders. Do you have any consumer lenders that you support through your software, through your program?
Absolutely. Yeah.
Okay.
What we primarily do, just kind of, and again, it's not about me, but a mortgage customer is usually a high value customer right out of the gate. Right?
Yes.
Like, it's much different than somebody who came and got a free toaster and put in $20, right? So we primarily do most of the heavy marketing to the higher value customers. And we're cross-selling all the bank services, the second mortgages, the credit cards, the investment services, commercial lending. So we do drip marketing for regular consumers, non-mortgage consumers, but a lot of the heavy lifting is focused on those high value, high net worth, high credit score, high deposit consumers.
Okay. So you do work in this, your program supports this world. Okay, good. Not just the mortgage. Okay. So the HELOC or home equity line of credit, good. Now,
I would guess 20% of the leads are for HELOCs.
Oh, really? Okay. Good. All right. Now, I would put this in your notes, and this is sort of a little tiny detour. Tax. We will talk tax a little bit throughout today's session. We will talk some tax. But here is a major tax issue related, and you should be aware of this. In my opinion, you should be aware of this. Do you see the second mortgage loan under the installment, where it's P&I payments monthly, versus the HELOC interest only? Both of these credit products, I put in your notes, the interest deductibility went away, is no more starting 1/1/18. What? For decades and decades and decades, we would provide, the banks would provide home equity loan, second on the home equity line of credit. And it didn't matter if Bob and Sue are imaginary couple based in the Lansing market, if they use the line of credit, the HELOC or the loan to put a new, remodel their kitchen, or to send their kids to college, or to go on a cruise, it did not matter. Starting 1/1/18, the TCJA kicked in. The TCJA is Tax Cuts and Jobs Act. This is a huge, huge overhaul of the US tax system. In fact, it's the biggest overhaul in over 30 years. And it was signed into law December of 17. It kicked in or became effective the very next month, 1/1/18. And so in most situations, the interest is not tax deductible anymore. There's only one exception. If the money from that HELOC or that home equity loan is used, if it's used to make, and this is actually in the tax code now, substantial improvement to the property, such as remodel the kitchen, then the interest may still be tax deductible. But to send the kids to college, no. To go on a cruise, for Bob and Sue to go on a cruise, no way. Now you may say, well, does the IRS put on their website, exactly what is substantial? No way. They're not going to limit themselves, tie themselves in, but remodel of a kitchen, a new roof, a new addition to the back of the house, those are substantial improvements. That is major. And I'm going to say it straight out from a marketing standpoint. And both of you market, you're involved in marketing. Kirk, you're involved in even supporting the marketing, and Michelle, you're involved live doing the marketing for the community bank. Well, used to be when we'd sit down with customers, hey, all these different parameters on that HELOC. And then at the very end, we'd say, oh, by the way, for most people, the HELOC, the interest off this line for most individuals in most situations is tax deductible. Today, we have to say just the opposite, in my opinion. From a marketing standpoint, we've got to say, in most situations, the interest is no longer tax deductible. Used to be like the icing on the cake from a marketing standpoint. Let's go to number 3. Pardon me, credit cards, Visa, Mastercard, pretty straightforward. Michelle, does your bank issue credit cards?
Yes, but we do it through a third-party provider.
That is exactly how it's done in most community banks. One of the 2 community banks I worked at, we issued them. The other one did not, but the one we did, technically, our name was on the card and so forth. But all of the underwriting, all of the processing, all of the management of it was through this third-party vendor, pardon me, and our bank simply shared in the fees.
That's exactly how it runs. Yep.
You bet. Kirk, in your world, are you involved in credit cards or not?
Yeah, credit cards is one of the products on our marketing for cross-sell.
Okay, good.
Now we don't get involved with the bank, which credit card the bank offers. But if they offer credit cards, we make sure that's on the marketing. So that
Good.
the consumer that receives the communication from the bank, technically from us, but they don't know it's from
Yeah.
us. It looks like it's coming from the bank.
Yeah, it looks like it's from them, but you're
Yeah.
the one or servicing it. You bet.
Right, providing the services. So it just reminds them that they can get a credit card at their bank, right?
Okay, good, excellent. Under number 4, personal unsecured lines. Some banks would provide this, some banks will not. Some banks say, oh, too much risk. Some banks will say, well, we'll go up to maybe 20,000 or 30,000 or what have you. Michelle, in your bank, do you provide personal unsecured credit lines to Bob and Sue from a consumer standpoint, not a commercial or business?
Credit lines of credit, no, but I do believe we do fixed notes, fixed loans. Yes.
Okay, so you may do a personal unsecured fix, but not a revolving line of credit.
I do believe that is the case. Yes.
Most banks would prefer number 2. If you're going to give them a revolving line of credit for consumer purposes, we want that second on the home. But a few banks will do this personal unsecured.
Has to be very specific credentials for us to do a personal unsecured.
Unsecured, you bet. Kirk, in your world, do your clients do many personal unsecured lines? Do you know?
We don't have anything on any of our marketing across the entire country. All the banks that say like signature loan or unsecured loans, like we don't promote that for any bank.
Got it. Okay.
Exactly. It's not promoted.
Oh yeah. Now some banks do, but not a lot don't. A lot shy away. What about bill consolidation? Now let me illustrate. The first of my 2 departments that I worked in, same bank, but like 15 miles apart in totally different markets. The first department, we did heavy bill consolidation. The second department, we were so busy with the RV loans, it's like, we don't have time for this. It was a different niche of the market. Well, bill consolidation, this is where we would have clients come in, Bob and Sue come in your office and say, well, we've got 3 credit cards maxed out and totals about 20,000. We've got another little personal unsecured loan. Would you take this all out? It's about $25,000. Some banks will do these all day long. A lot of banks will not. Michelle, will your bank do a bill consolidation loan?
We actually do. We call it debt restructuring, I believe is what it's called.
Okay.
We do that, but again, the credentials for those are very strict and precise into what we will and will not do.
Good. Yeah, this is a specialty, and not all banks will step up and do it. What's the big risk to your bank or to your client? If you're Kirk, your client, which are the banks, well, the big risk is, and this happened to us, probably, I'm going to guess, probably upwards of 15-20% of the people that obtain these loans within just a few months were back into their credit cards. Credit card companies are aggressive. The bank sends out a cashier's check with the letter saying, please accept this cashier's check, please close the line, and we have the signature of Bob and Sue. Within 2 or 3 days, Bob and Sue open their mailbox, and there is believe it or not, there is a new credit card, and there's a letter. Oh, we understand you lost your card. Well, they didn't lose their card. But credit card companies, once again, they can be very aggressive. What about student loans? Specialty. Kirk, do you deal with student loans in any way, shape, or form?
Yeah, so we do have consolidation loans and student loans on our marketing.
You do?
Yeah.
Okay.
And that's across this country. Like, we don't have any bank that's told us to take them off. Traditionally, though, we'll redirect those leads back to the mortgage loan officer.
Oh, okay.
So
Good.
in other words, the mortgage loan officer is saying, hey, I understand you've got some debt you'd like to consolidate. Let's look into a second mortgage, or you have some student loans that you need to consolidate. Let's look at a student loan program versus, HELOC or a second mortgage.
Gotcha.
So the banks use those wording to identify potential mortgage opportunities.
Got it. And what did you refer to once again? The bill consolidation? What was that called?
We just have them listed as consolidation loans.
Consolidation. Good.
Yep. And
Okay.
student loans. Yep.
And then the
of
student
those
loans.
both of those are on our websites and our lead forums and all the markets.
Okay. Good. Now, for whatever's worth, student loans, up until about 30 years ago, you can go to any bank in town, anywhere in America, and get a student loan, but not today. Student loans have become a real specialty. Michelle, is that
we
true?
outsourced ours. We had to outsource ours
Okay.
to a third party. With
Got
our
it.
logo, everything looks like us, but when they're driven out to the website, they're actually going to a third party.
Good. Similar to the credit card, it's a third party. Yeah,
Right.
because student loans are, the reason why they're a specialty, twofold. Number one, the regulation with the Department of Education is so steep. And number two, the default rate is high. So, wow, a lot of banks have shied away from them.
And I
Or-
wanted to correct my previous statement. I had to look because I'm not the lender, I'm the processor. We do offer one consumer unsecured loan, which is our demand. It's called our demand deposit loan, and it's tied to the checking account for overdraft purposes. So we do
Okay.
offer a very
Yeah.
small,
But
one that's unsecured.
it's for overdraft purposes, correct?
Yes, yes.
Got it. Okay, thank you. Now let's move forward. Page number 6, still in this intro section, history of the consumer lending. Well, what really pushed it forward? Industrial Revolution, late 1700s, early 1800s, England traditionally, the start of the Industrial Revolution. Before that, the whole world was agrarian economies. People lived on the farm. Everything was provided by the farm, their housing, their food, their clothing, everything. Well, now all of a sudden they get into the big cities and these factories and all this. Well, all of a sudden merchants say, well, wait a minute, we'll extend some credit. All of a sudden consumer lending, which consumer lending has been around for thousands of years, but the real growth in the modern world, Industrial Revolution, early 1900s included here in the United States, post-World War II, probably the biggest growth. Late 40s, all the way through the 1950s, the GIs are back from the war. Pardon me, they've got to buy 2 items, a house and a car, and they'll finance both of them. 60s and 70s regulations. When we get into our compliance section later on, towards the end, where we're doing the end of the entire consumer loan process, most of the major consumer loan regulations came about in the late 60s and the 70s. In the 1990s, 2000s, technology, including Kirk, your business, your company. Could your business have existed 30 years ago, Kirk?
No, sir.
No way. No way.
Well, technically, our business did exist 49 years ago. In January, it'll be 50 years. But back then, it just sent out keep in touch mailers
Okay.
from the mortgage loan officer.
Okay.
So
Got it. And that was it. It was limited.
it was limited
Good.
just to physical mail that was sent
Yep.
out over multiple mailers over 5 years, so that that consumer would remember to call their mortgage loan officer instead of go to a different one.
Good.
That's what it did in January of 1973. But yeah, as for all the software, the email marketing, online lead forums, surveys, website, technology, all that stuff, no. Of
Yep.
course.
Of course not. Good. Moving right along. Now, page number 7, competitors. Now we're going to go into the marketing section. The marketing section. Who do you compete with? Michelle, you compete with other community banks. Is that true?
Yes, and there's a lot of them in our area. There's a lot more small community banks. I mean, one little small town that you would think that's got one gas station and not a grocery store, they might have 2 or 3 community banks in the same little area. So there's a lot of competition with the
Good.
small community banks.
Good. Regional banks, large banks. Who do you compete with, Kirk, in your world, your quote unquote loan servicing world?
Yeah, we've got a couple competitors. One's out of Georgia, one's out of
Pardon me.
California,
Okay.
and they're also providing similar services to banks, credit unions, mortgage companies, as we do. So it's usually when a bank is serious about actually generating revenue and business development and marketing and mortgages, and when they really want to drive consumer lending, it'll usually be the 3 of us at the table.
Okay. Good. Excellent. Non-bank, but regulated under Part 2. Michelle, do you compete with credit unions at all?
Yeah, there's a couple credit unions in our area too, and they're
Okay.
hard to compete against. They're very difficult to compete against.
Now they're non-bank, but they're regulated,
Right.
and they can be very aggressive, especially on rates, terms,
And
so
they
forth.
are. They
in the
are.
consumer lending arena.
Yep,
You bet.
exactly. You nailed it.
Kirk, thank you. Kirk, in your world, do you deal with any large credit unions? Because most of your clients are regional banks. What about large credit unions?
Yeah, so the answer is yes. We have about 10 credit unions that use
Okay.
our software and our marketing. They all have over 10 mortgage loan officers.
Yep.
They're very large credit unions. A lot of the small credit unions use like CUSOs to do
Yes.
mortgages.
Yes.
So these are bigger credit unions that use our software. But here, I have a question for you, David, since it's such a small group. Hopefully,
You
Michelle,
bet.
you don't
Oh,
mind.
no, this
go
is
right
no,
ahead.
yeah, that's open discussion.
When did the credit unions get the permission to go after commercial business?
Well, okay, let me answer it.
Because that seems like it's only changed in the last few years.
Yes, okay, let me explain. In fact, if in fact, in some of my other presentations, I actually have the acronym CUSO. If you would write down CUSO here underneath credit union. Now, the reason why I don't have it in this presentation, I do in my commercial lending, because a lot of CUSOs are set up, they're consumer, but most of them are set up for commercial lending. A CUSO, CUSO, stands for Credit Union Service Organization. Credit Union Service Organization. Now, years ago, the US Congress limited the amount of loans that a credit union could provide to a business loans. They call them in a credit union member business loans, or MBL for short. Okay. Member business loan. And typically, or traditionally, mathematically, it's been limited to 25% of the credit union's equity. So mathematically, whatever their equity is, it's 25%. Well, this was put in place. This restriction was put in place. And not to speak out of school, but the Michigan Bankers Association, MBA, and many of the banking associations that each state has one, they band together and they work together even from a national level to fight against this, because it's competition. And not to get in depth on this big, huge controversy, credit unions are not for profit. They don't pay tax, banks do. So the Congress, lobbied by the banking community or banking industry to limit the credit union's ability to make these loans. Well, several years ago, someone came up with this idea. Why don't we set up a separate business and we'll call it a CUSO, Credit Union Service Organization. And the CUSO is, and I would write this down, is a for-profit business. They're in today's world, they're usually LLCs, limited liability companies. And it's like essentially functions like in the banking industry, we call them LPOs, loan production office, or LPO for short, loan production office. The QSO is separate than the credit union, but it's tied into the credit union. To be a QSO, you have to have at least one credit union as the sponsor. And traditionally, the way it's structured, the ownership is the QSO, one of the owners, and of course, one of the board members of the QSO is the credit union. So traditionally, one of the executives from the credit union will sit on the board of the QSO, representing the credit union's ownership in the QSO. But the other board members of the QSO are just local businessmen and women, almost like a community bank. Michelle, in your bank, you have outside directors. Is that right?
That is correct.
Roughly, how many directors do you have? 8, 10, 12 directors?
I think 7.
7.
I think there's 7.
7 directors, same idea.
Mhm.
So when a QSO is set up, it's almost takes on the kind of the complexion or the attributes of a small community bank from an ownership standpoint.
Mhm.
But they've got to have this credit union involved. And it's a for-profit business versus not-for-profit. And there are other owners, if you will. It's not just the credit union. It has to be all these other owners. And once again, it functions. Now QSOs are set up to do all sorts of servicing, credit cards, consumer loans, commercial loans, and so forth, insurance products as well. But from my experience, most QSOs are set up today, or a lot of them are set up today to do commercial lending. Because by doing the commercial lending, the credit union, I'm just going to say it straight out, they get around the 25% rule that the US Congress put in place. They literally get around it and are able to fund extensively additional commercial loans. Now, who funds these loans? The credit union does. It's like, wait a minute, it's like, well, wait a minute, this restriction's in place. Well, who actually is funding these loans, putting these loans on their books? It's the credit union. One other thought, we move on. QSOs, Kirk, also, they'll be sponsored by one credit union, but most QSOs will end up working with multiple credit unions. Just a thought. So multiple credit unions are using the QSO to underwrite the commercial loan or member business loan, to service that commercial loan as well. Does that make sense, Kirk?
Yes, sir. Do you know, was there a law that changed that allowed them to start using QSOs, or was it just a creative way around the system?
My understanding, it was a creative way around the system.
Okay.
But I will say this, because in some of my training, I have one large organizations nationwide that I do, the 1.5 or 2 hour webinars, and it's just pure webinars. It doesn't have a ground base like the Michigan Bankers Association, whatever. They have a bank division that I train under, and they have a credit union. Well, I will say this, that it seems like in the last few years that the QSOs have just expanded more and more and more, competing primarily with the community banks within commercial lending. Does that make sense? You bet.
Absolutely. See it everywhere.
Oh yeah. Yeah. And it's mushroomed over time, big time.
And it's really hurt the community banks, because
oh yeah,
that's where a lot of the revenue and their profits came from. right?
Yeah.
And we are so highly regulated and they have so much less of the
Oh, yeah.
regulatory requirements. It's hard for, like I said, it's almost like you can't compete with them.
Yeah, and it's hard. And mathematically, going back to remember I said we would touch on some tax issues throughout today's session. Well, mathematically, because the bank is taxed and the credit union is not for profit, it's hard dollar for dollar to compete. Now, a lot of bankers get, especially senior management, they're involved in this whole issue, and the associations, the banking associations like the MBA. Well, a lot of bankers that I work with, a lot of commercial lenders, bank managers, you name it, senior management, they say this. And I personally agree with this for whatever it's worth. Boy, the original credit union idea was fine. Boy, it was associated with Ford, or, General Motors or whatever, or, for the employees and benefit the employees. But credit unions are way different. They are now credit unions, as you well know, both of you know this, multi-billion-dollar credit union. I mean, it's like, what? And it's not for profit. It's like, what? So, I mean, that's where a lot of the bankers, they get really uptight about it. Wow. Moving on to non-bank. Now we talk about credit unions as competitors. The latest and greatest inroad against our industry. Whoa, 3A.
Rocket Mortgage.
That's it. FinTech. I would highlight FinTech. Pardon me, stands for financial technology. These companies, Kirk, you talk about in the last few years, Kirk, in the last 3 years, the FinTech companies have exploded. Do you deal with any of these at all?
Well, technically my company is considered a FinTech company.
Okay.
But I don't have any FinTech companies as customers. My customers are banks, credit unions, and traditional mortgage companies.
Yep. So yours are banks, credit union, and then of course mortgage companies. And that's why you mentioned the at least 10 mortgage lenders or above 10 or what have you.
Yeah, there's small mortgage brokers that kind of work out of their house, and they write through like United Wholesale or through Rocket. They have to be like a real mortgage company with at least 10 loan officers, or we won't work with them.
Got it. Now the FinTech companies have expanded, well, because of technology, but this is huge. Non-bank, non-regulated. Everything's on the cell phone. Everything is technology driven. Let me illustrate. I was training downtown Seattle, the bankers, credit analysts, commercial credit analysts, commercial loan officers in a full day ground-based session right before the pandemic hit. Well, we went around in the morning. We had about 15 people in the session, ground-based, and we went around, did introductions. And one gentleman says, well, I'm at such and such community bank. And it was a Thursday. And he goes, for today, but Monday I start at my new place. And he didn't say bank. And so a couple of people said, well, what bank? Because it's kind of a close knit, even though it's a big city, the Seattle Puget Sound market. And he goes, well, and he sheepishly says, well, it's not really a bank. And everyone goes, well, where are you going to go? And he blurts out, Amazon. Everyone goes, Amazon, including me. I go, what? And they go, well, what are you going to do there? Oh, I'm joining a brand new commercial lending team. And they go, what? Where? We're on the 21st floor of this building. He says, go to the edge of the room and look down to the old Macy's building. We're going to be occupying most of that building. And everyone's going, what? FinTech, Amazon. I mean, they have a physical location of all the underwriters and so forth, but they're going all the way all through the country. The Amazon. And it was really interesting. The first break, everybody, all these community bankers were going over and giving them cards. Hey, here's my card. Here's my business card. Here's my personal cell number, what have you. In the Seattle market, of course, Amazon is that's where they're based, huge employer. And boy, all the people were, all these credit analysts, wow, Tell me about what you're doing there, so forth. Now, some fintechs are actually applying for bank charters. You should keep that in mind. Some fintechs are applying for bank charters. Also, up until about 2 years ago, some of the big banks in America came out. B of A, Wells, Chase, those type of banks, Citibank, they came out and says, we're going to fight the fintech companies. Less than 6 months later, they did a reversal. Their systems are, in so many words, their systems are better than ours. We're going to join them instead of fighting them. One other thought, Michelle, this is for you. Some community banks are now partnering with the fintech companies to deliver the consumer loans and so forth, because and it helps them, the smaller community bank, branch out beyond their market. Kind of interesting.
Yeah,
Moving right along. Go ahead, Kirk.
In my opinion, and I'm starting to see it, but that's a two-edged sword, because once you start doing that, they now have your customers.
I agree with you 100%.
Thank you.
That is huge. That is a huge comment, Kirk. That is huge, because I mean, unless there's a way you can protect your area. And you said you're in Kitchen. Is that what it is? In Michelle, how do you pronounce the name of your town?
Pigeon, just like the bird.
Oh, Pigeon. Gotcha. Pigeon. I'm
Yes,
sorry.
Pigeon,
I
Michigan.
heard
Yep.
it wrong. Okay. And what town are you actually in, Kirk? What town or city?
Commerce, Michigan.
Okay. How far are you from Ann Arbor?
If you went straight north, 30 minutes from U of M.
Okay.
So about 20 miles north of
Okay.
Ann Arbor.
But you're in Commerce. Okay. So Pigeon and Commerce, boy. But in my opinion, if you could protect your market, for example, Michelle, Pigeon market, and then you're lending into the other areas, like I've seen this, where a community bank, basically partnered with the fintech to deliver consumer loans and mortgage and commercial, but a lot of consumer loans in another market to fund those. And they do the underwriting and so forth. And the community bank is sort of like it's really almost like two different businesses. And the bank benefits fine. But Kirk, your comment, you're right. Boy, watch out. Who's going to start controlling whom? The bank or the fintech?
Well, this has been a challenge in our industry for 10, 15 years, is that a lot of the loans were sold to B of A, right?
Yes.
A lot of the mortgages are sold, they're
Yeah.
resold, the servicing sold. And B of A had very specific rules where they would sign all these contracts with these community banks that they would buy the mortgages and the community
Yeah.
banks wouldn't have the liability. But they only had to wait 6 months. And then they started marketing directly to the consumer.
Wow.
To join B of A, right?
Wow. Wow. And cut them out. Wow. That happens. Yeah. That's a very good point. Let's move forward. Now, further in our marketing piece, we're still in this marketing section. Life cycle, stage, and Bob and Sue, our imaginary couple. Where are they at? Well, they're number 4, midlife empty nesters. But what about individuals or couples that are in their teens, 20s, 30s, 40s, midlife retirement? What I'd like each of you to do, spend just a moment on this. List at least 1 or 2 products, consumer loan products, to the right of each one of these stages of life. So we're playing off stages of life, but we're marketing the consumer loan product to these stages of life. So take just a moment, just 1 or 2 products to the right, please. Pardon me. take another moment or two and we'll come back together. 1 or 2 products for each one of these stages of life, the life cycle. This is marketing. We're upfront marketing the consumer loans. We'll underwrite in just a few minutes. We'll start to underwrite. But we've got to have volume coming through the door. Okay, we've got to have volume coming through the door. So 1 or 2 products in each one of these stages of life. Someone in their late teens, 20s, 30s, 40s, so forth. Typically, they're going to be at least 18 or above, late teens. And then retire all the way down to retirement age. Okay, here we go. Kirk, what would you say for late teens? What's one product?
I put debit cards and checking accounts.
Good. Michelle, how about you? From a consumer loan product, what would you say for late teens?
I put college loans and credit cards.
Good. Okay, 20s. Kirk, what would you say people in their 20s? Could even be late 20s. People in their 20s.
I put credit cards, auto loans, and mortgages.
Good. Michelle, what about 30s and 40s? Now they've built up a little equity in that house. What would you say?
Home equity loans. I put auto loans or even debt reconciliation, even though we don't market that, but
that's
really
it.
at that age.
That's good. By that time they've messed it up. I'm just teasing.
Yeah.
That's good. Kirk, what about midlifer empty nesters?
Okay, well, just for the record, though, I totally agree with Michelle. I put debt consolidation too. And I know that I got married when I was right around turning 30.
Yep.
And it turns out my wife and I needed one of those too. So we had like her loans and my loans weren't bad, but when we got together, it's like, okay, we need to put this 15 grand on a term loan to get rid of this stuff, right? So,
yeah.
So I was totally agree with you, Michelle.
That's about the age when they start looking at that too. So
that's true. That is good. That is good. So Kirk, what about midlife empty nester?
I put financial planning and reverse mortgages.
Good. Especially you've got to be 62 or above to do the reverse mortgage, but that's good. Michelle, any others on the midlife empty nester?
I kind of put like a home equity loan. At that point in time in their life, they might be looking to do some other things that they don't have the financial ability to withstand, whether it be home improvement or whatever.
They take the home equity loan or line of credit and they buy like a home on the a cottage on the lake or second
summer
home or something.
Yeah.
A summer home, you bet. Good. Excellent. What about retirement itself? Any other ideas, Kirk? Retirement.
Yes, I have more financial planning, more reverse mortgages, and also real estate services.
Okay, good. How about a consumer product such as a boat loan? Boat loan can be 20s.
RV loan. An
RV.
Oh, I never even thought about that because those are the only people that can truly afford it.
And David's been talking about RV loans all morning, so we should remember that, Michelle.
Yeah, RV loans would be typically the number 4 and number 5 both. Boat loan, maybe even 30s, 40s, so forth. Good. Let's move forward. Excellent. Now, for the marketing model, target market and the 4 P's of marketing. Underneath auto loan, if you'll please put in your notes, 35,000, 35,000, please. Below the RV loan, 75,000. Below the HELOC home equity line, 100,000. So 35, boy, Bob and Sue that live in Lansing, both have good jobs. Sue works for one of the state agency. Bob is he works for a different company. He works in marketing, similar to you, but a little different, Kirk. He works in marketing. Sue works for the state agency. Well, they could have an auto loan, $35,000, $75,000 recreational vehicle or RV loan and $100,000 HELOC. The targets, we're going to use these three broad categories throughout today's session, including our underwriting and so forth. 4 P's of marketing, otherwise known as the marketing mix. The marketing mix. This is how we deliver to the target. What is marketing? Finding the niche or need, in the market, and we fulfill the need. What need under the product? Over to the right underneath auto loan, the first column, what need are we fulfilling the product? Transportation. So we're going to fill in this table together. To the right of number 1 product underneath auto loan, I'd put transportation. To the right again, underneath the RV product, over to the far, to the right there in the middle column, RV, recreation. And the HELOC over to the far right, various. Remember, once again, we talked briefly on the tax write-off on the interest. What about place? This applies to all 3 of these product areas. The place for your bank and or Kirk, your service, I'd put off to the right, physical or virtual and or virtual. Physical and or virtual. Physical. Michelle, how many branches do you have in your bank, your small bank?
Well, we just purchased another branch, so we have 4.
4 branches. Okay.
4 branches in the entire, like the tip of the thumb. We kind of service 4 different areas, or 3 different communities.
Yeah. So you have 4 branches. If you are running an auto loan special, Michelle, you would have a sign or placard in all 4 of those branches. That's a physical marketing.
Yes.
Virtual, you would attach the same type of ad to your bank's website. Kirk, in your world, yours is all virtual. Is that true?
Correct.
It's all virtual.
Yeah, because it has to be virtual because we're technically sending it out for all the banks and the banks aren't in our building, right? So.
Yep. Yeah. You bet. Let me ask you this, just curious. You said you had about 160 clients nationwide. Do you physically go and market to them, or is it all word of mouth? I was just curious. Is it over the phone? Is it virtual itself? How do you do it? Or, originally, did you go out and meet with the banks?
I've probably met with 2/3 of them in person.
Okay.
I traditionally met them at what's called the Mortgage Bankers Association conference.
Got it.
And it's usually people find us when they search like more mortgage volume or mortgage sales or mortgage lead generation or something like that. They find our website and then they'll inquire for like a demo of our software.
Got it. Okay. And there is some word of mouth, right? Other regional banks refer you to other regional banks. So
yeah, I actually have, like, it's crazy. Now we're headquartered here in Michigan, but I have like 2/3 of the banks in Michigan.
Wow. Interesting. Price, off to the right of price, it applies to all 3 categories. Very, very competitive. Would you agree with that, Michelle? Pricing is very competitive. Oh, and then promotion. Promotion, the last of the 4 P's, advertising and personal selling. If you'll turn forward, advertising, page number 10, personal appearance is huge. Now, Kirk, in your world, you're behind the computer. You could dress however you want to. Is that true?
Yep, I'm wearing jeans today. It's Friday.
That's it. Look at that. He's showing us his jeans. Now
I'm wearing jeans today too, because that's our policy. Jean Day Fridays.
Jean Day Friday. Now, though, I'm going to say this, though. This is mainly for Michelle. If you have Jean Day Friday, which a lot of banks do, I would recommend you still only make sure that those people on the front line, they don't do the lower end jean, but the little bit higher. Now, I'm not saying they have to have, a pair of jeans that cost $200 a pair or $300 or whatever, but definitely a
You're
little
talking
bit
about
on
holes
the,
in the jeans, aren't you, David?
that's it.
We are not
Exactly.
allowed to wear holy jeans. Holy
That's
jeans
it.
cannot, you have to have, they gotta look kind of like you care about what you look like,
Exactly.
Yeah, but
Exactly.
we live in a very rural area where if we came in dresses and skirts and stuff, our farmers that would be walking it would feel out of place. So we kind of try to be a little bit more casual here to meet
Yes.
our community so they don't
Yeah.
feel like we're
Good.
performing at a higher rate. So yeah.
Good. Excellent.
But we wear logo wear, and of course I'm not wearing any today, so don't say anything, but we normally have lots of
Yeah.
shirts and things
Yeah.
that have our logo.
The name
and
of the
that's-
bank. Yes. You bet.
Yep.
No, thank you for that feedback, both of you. Part B, the handshake, or in the era of COVID, the elbow or the fist pump. Now, I just need to ask, and this isn't to get into the COVID issue and so forth extensively, but just curious, in commerce in your area, Kirk, are masks still required or not?
They just subsided from the mask in our schools, and the schools were one of the last ones to still require masks.
Okay. And Michelle, how about in your area?
We are pretty much wide open. I think the only places that we have to be concerned about are like our medical facilities. Some of the medical facilities still require that you wear masks to come in, but you can go to restaurants, you can be in the school system. We're pretty much wide open.
Got it. Got it.
Mhm.
Business card. Business card. Always have a business card on your person. Even when you're off duty, if you will, because you never know when someone's going to walk up to you. Oh, I've been meaning to come down to the bank. Or Kirk, even in your world, I'm not saying mixed business and vacation, but all of a sudden you're someplace and you're talking to someone and they happen to be a senior VP at a regional bank, and you're going, you're kidding. Now, what do you do? And they say, I know where I'm, and you just meet them. You're in Florida or something, Kirk, and that sounds strange, but do you have a business card on you? Oh yeah, here it is. Way you go. Speech patterns, clear and concise. I'd put under part D, especially when you're negotiating terms and conditions of the consumer loan. Listening skills, huge. Social media, part of advertising. I put LinkedIn. Most bankers, most business people, that's a common one as far as social media.
Yep.
Moving right along, page number 11. The other side of promotion, personal selling, including negotiations and communications. Okay, this is an individual grade, if you will. On a scale of 1 to 10, 10 is the highest, 1 is the lowest. 10 is the highest, 1 is the lowest. How would you rate your negotiation skill set? 10 is the highest, 1 is the lowest when it comes to consumer loans or in lending in general. And obviously you're coming at this from totally different areas.
Yeah.
Michelle, small community bank, and of course, Kirk, the platform, the servicing, so forth. How would you rate yourself?
It would depend on the topic, I guess. If we're talking just consumer lending, which I don't do, and that's why I'm here today to learn.
Yes.
Right now, I would give myself maybe a 5.
A 5.
But the more I
Okay.
know, the better I am. So then there
Good.
you go.
Okay. Kirk, what would you say when it comes to the consumer loans within your world that you do support, including mortgages and so forth?
I would actually rank myself probably an 8 on a scale of 1 to
Okay.
10. But in the fairness of full disclosure, I've negotiated with banks for myself
Uh-huh.
Yes.
and for my business and for my buildings and commercial buildings and real estate buildings and everything that I've owned. And I've also been sent to like $60,000 worth of negotiation training when I was in the automotive industry.
Whoa. Okay. Yeah. That's in the auto industry. You were in engineering, but you're in the auto industry, right?
I was in the sales side, right? So
Oh,
like I went
okay.
to Karis, effective negotiation. I mean, I've been to
Okay.
a lot of different negotiating training.
I just curious. Your background is engineering, but in the automotive industry, you were mainly in sales. Is that right?
Yeah, I started out as design engineer and then I became a development engineer. And then they realized that I was on the engineering scale, I was pretty charming. So they put me in sales.
Okay, all right.
Now I know that
And really, engineers and charming don't normally
That's what I was.
go.
That's what I was
Not to
alluding
be,
to.
I'm not being judgmental, but normally most of the
Yes.
engineers, they talk up here to the layman.
Yeah.
You know, Michelle, 100% agree with you. And like I said, if you hear what I said I was charming on the engineering scale, meaning
Yes.
I wasn't charming on
Not on
the
the
normal person
on
scale.
not on the other. Great. Thank
Not on
you.
a normal person scale, just on the engineer scale, I was considered charming.
On the engineering, good. Turning forward, let's go ahead and we'll stop right there. Let's take our first 5-minute break and we'll
I was
come
going
on
to ask
back.
you.
One
So
thing-
let's go.
One thing before you leave, though, I want to just give you something, just a suggestion. And
Yes.
again, you're the boss, like you're the one training us. I think you need to add one more to page 10.
Okay. Yes.
Online reviews.
Okay.
Online reviews. So just a suggestion, maybe if, next time you're updating your PowerPoint, you might want to
Yes.
add that one on there. That has become huge, not only in products you buy on Amazon, but even in banking, consumer lending, auto loans, mortgages. Online reviews is actually, in many cases, more important than social media.
That's
You know what?
good.
You're right. You're right. One
Yeah.
bad review can just kill somebody.
Yeah.
Yeah.
Sorry to delay or break, Michelle, but
No, that's good. That's
I
good
just wanted
though.
to give David that.
No,
feedback.
thank you, Kirk. That is excellent idea under the advertising, online reviews. Good. Thank you for that. Okay, now let's move forward. Page number 12. We'll stop right there. I recommend you keep everything up and, in other words, the whole system, and then you can mute yourself, whatever, and so forth, and then we'll come on back. But we'll come back in 5 minutes. Thank you, both of you. Excellent participation. Talk to you in 5. Welcome back. We'll get started in just a moment.
I am here. I just didn't turn on my camera yet.
Okay, no problem, Michelle. We'll wait just a moment for Kirk and we'll get started.
I'm finding you on my LinkedIn and I'm sending you a connection.
Oh,
If-
great.
If
Thank
you're
you.
out there, there's a David Osborne, but that's not you. There you are. I found you.
Great. Okay, let's go ahead and get started. The 5 C's of credit. This next section, section number 2, this is solid consumer underwriting. Now, right below auto loan, if you'll please put 35,000, right below RV, 75,000, and below the HELOC, 100,000, just as a point of reference. I'm going to give you a brief definition of each one of these 5 C's. Then, of course, they apply to each of these product categories. Capacity is defined as follows. Cash flow, the ability of the borrower to repay the loan, or their cash flow ability. So cash flow. Capital, debt versus equity. Debt versus equity. What do you mean by debt versus equity? Well, we provide the majority of the debt. For example, on the auto loan or the RV loan. Bob and Sue are imaginary borrowers living in the Lansing market. They put a certain amount of equity into the deal. Debt versus equity, or the capital. The capital would be the equity. Collateral, defined as follows. Pardon me. Assets pledged to support the loan. Assets pledged to support the loan. Conditions. Economic conditions. Economic conditions. And lastly, character. Willingness to repay, defined as the willingness, not the ability. The ability is capacity, with capital, collateral, conditions, so forth, as the impact on their ability to repay. But character is their willingness to repay. Do they want to repay the loan? Okay,
I'm sorry, I missed, David, what you said regarding the capital. You said down payment?
Yes, the debt versus the equity. Their down payment is the equity. Their down payment is the equity in the deal versus
Yes.
the debt is our loan. It's
Right.
to them, it's a debt. To us, it's an asset. Our
Right.
bank, it's an asset, but to them, it's a debt or a liability.
Okay,
Good.
thank you. I
You're
just wanted to make
welcome.
sure I heard that correctly.
You bet. Now we're going to go in depth on, pardon me, we're going to go in depth on the 5 C's themselves. Okay. Before we do so, let's turn back to page 12. Turn back to page number 12. Of the 5 C's of credit, which would you say is the most important? Kirk, what would you say? Of the 5 C's of credit, which would you say is the most important?
I would say either capacity or character.
That's exactly
Okay.
what I was bouncing
All
between
right.
the two of those.
This is a controversy. I show this to a lot of groups, and boy, they say the exact same thing. In fact, some people will just blurt out capacity. Well, because that's their ability to repay. But technically, if you had to say, well, which is the most important between character, capacity, character, it's character. Because you'll have borrowers that have the capacity to repay, but they choose not to. Back in 08, 09. Okay, Kirk, were you doing your business back in 08, 09, the Great Recession?
I wasn't the owner of Continuity Programs back then, but I did have another business, which is a residential real estate business with
Okay.
a half a dozen rental properties.
Okay.
And even in the really stressful times,
Yeah.
we made every rent payment or every mortgage payment.
Got it. Because you had the willingness to repay. There are some people and some businesses during that era of the Great Recession, 08, 09, even into 2010, that did what are called a strategic default. And what does that mean? Well, they had the ability to pay the capacity. They chose not to. In fact, I had a CFO client at the time. He had 3 commercial real estate loans with the same bank. He walks in my office once, and one day he goes, call the loan officer and tell the loan officer we're not going to make payments anymore on property A. Oh, but B and C we're going to keep current. And I go, what? I said, no, we can't do that. And he goes, oh yeah, that's what we're going to do. I had to show him the loan documents. I had to pull them out of my credenza and show him the documents where there's a legal phrase that says cross collateralization. And he goes, what does that mean?
We just talked about that. We just talked about that.
Oh, really? He goes, what does that mean? And I said, well, you default on loan on property A, the bank will foreclose on all 3 properties. No way. They can't do that. They don't have the ability. They don't have the right to do that. I said, oh, not only do they have the right, but they will do it. So Michelle, you just talked about this in your bank and some sort of
we had our lender
right?
meeting and our loan processor meeting, and someone brought that exact statement up because I don't know what drew it, but they said there is a clause in our loan documents that says if you default on one, we can make all of your loans go bye-bye.
Yep. It's
and
true.
and we just talked about that. That's interesting that just came up.
Yeah. No, and it happens. Now, today, not so much. Even though we've got a real mixed market economically today, the Great Recession, in my opinion, was worse than today. It was a general recession, whereas during the era of COVID, some industries annihilated. Some industries actually have done better. Kirk, in commerce area, even right now with everything going on in the world, is residential real estate strong in your market?
Correct. Yeah, the only thing that we lost 2 restaurants in the area.
During COVID?
2 restaurants, 1 dry cleaner.
Okay.
But everybody else, I think, actually came out better.
And then, good, excellent. Now, now we're going to dive deep into each of the 5 areas. This first area, capacity cash flow, we're going to spend the most time on. You're saying, well, wait a minute. You said character is the most important. Well, it is. But even though it is, from an underwriting standpoint, this is kind of the math part, if you will. This is the technical side of the 5 C's, the most technical. The others can be technical as well, but this one, we've got to have it down pat. And Michelle, if you're training people in your bank, or Kirk, you're interacting with your clients with their consumer process, wow, this capacity, we've got to have it right. So we see the definition cash flow, debt to income ratio, DTI. Now, let me ask, have either one of you ever done or calculated a DTI?
Yes.
Okay. Michelle, you have. Kirk, have you ever calculated this?
Absolutely.
Okay. Let me have you put an example off to the right. Okay. It's a simple key ratio that we use in consumer lending. Mortgage lenders also use it, by the way. And I'll come back to that in just a moment. Off to the right, if you'll put a what if scenario, in the numerator, we put our set monthly our set monthly payments in the numerator. And I'd write that down. In the denominator below the line, we put the gross household monthly income. So the regular set monthly payments for the household in the numerator divided by the gross household monthly income in the denominator. Okay. Debt to income ratio. Let's use an example, Bob and Sue. Bob and Sue that live in the Lansing area, they have a $2,000 a month house payment. Just to keep the numbers simple. They have an auto loan for $500 a month, P&I. They come to your bank and apply for a second auto loan, $500 a month projected. So in the numerator, 2,000 plus 500 plus 500, or $3,000. In the denominator down below the line, let's say their gross household monthly income is $6,000. We do the math. The DTI is 50%. You can see under number 2.
Yeah. Question.
Most banks will not go above 50% today, nationwide, with
David,
this underwriting. Go ahead, Kirk.
is that calculated on gross or net?
Well, interesting. Okay. Years ago, most consumer lenders, including myself, we would use net, but then all of a sudden over years, over multiple years, what would happen would be that the lenders would add back, like for example, oh, wait a minute, this contribution to their 401k that's coming out of their paycheck, out of, net income, whatever, or, or charitable contribution or whatever was coming out of their check. And so it's like, well, we're going to add this back in. Well, we're going to add this back in. Over time in our industry, it changed from net income to gross, but the percentages changed as well. Today, most consumer underwriters nationwide, it's gross household monthly income in the denominator, and it's 43% max. I would circle 43. That is the most common nationwide today.
Okay, I was just looking at ours. Ours is 38.
Whoa, that's conservative.
Yeah, that's why I had to look it up because yeah, and I'm like, yeah, our debt to income ratio is 38, but I don't know. I'm trying to see if they we're looking at net income.
Well, then that may be why.
Yeah, because it looks like we're looking at net income, not gross.
Yeah. But 40.
Wouldn't that make her more conservative though?
That actually, I just thought that, Kirk, from a mathematical standpoint, that'd make it even more conservative. Actually, back in the day, the max back when we would use net was more like 46, 47, 48. Does that make sense, Kirk? Yeah. Mathematically. So it was higher because you're using net. So if you're using net and you're at 38, whew, that is conservative. Let me ask you this, Michelle. Does your bank do a lot of consumer loans? Because some community banks, they say, well, we do all forms of lending, but really they're for lack of a better word, they're a commercial bank. Does that make sense? Commercial lending.
We are primarily commercial and ag lending. Yeah. We cannot compete in the mortgage world because we don't have the long-term fixed mortgages. We offer short-term. Yes. And so, yes, we compete more heavily in the commercial and agricultural.
And that's common. That's common. I have a good friend. He's the president of a community bank here where I'm based in Las Vegas. And I mean, they say, well, we do consumer loans, mortgage loans. Because it's a small bank, they will refer out to an outside party or group. But really, when it boils down to it, they're not a consumer. They really don't do consumer loans. Those are what are called accommodation loans. Their
Basically.
major lending, their major lending is commercial business loans. So, but nationwide, 43% is the typical. That's the standard max on this one. 50% with an exception. But was a month or so ago, I had a big group of lenders. We had everything from 38 or 39% all the way up to 46 or 47. So it will vary per bank, but on average, it's 43% today. Okay, now we have the DTI. We calculate it. Now let's refine it even more. Now that's the basic model. Somewhere on to the right of number 2, you've got space off to the right. We mentioned earlier, okay, in the numerator, the set monthly payments, in the denominator, gross household monthly income. Well, gross household monthly income, pretty straightforward on the denominator. But let's refine our analysis on the numerator up above. If it's that house payment Bob and Sue have, it's usually, most lenders are going to use the PITI, principal, interest, taxes, and insurance. Okay. What about the auto loan? Well, the first one, P&I, yeah. Second one, P&I, principal and interest, yes. What about credit card debt? This gets tricky. Some lenders do it one way, some lenders do it another, some lenders even do it a third way. With credit card debt, if it's existing, today when you pull the credit report, it will often show you, well, what are the set monthly payments, minimum payments? And a lot of lenders will just take those set monthly payments. I'd write that one down. But what if the credit report doesn't show the minimums, which sometimes it doesn't? This is an old rule of thumb. You take the outstanding credit card debt times 3.5 to 4 to 4.5 to 5%, usually somewhere between 3.5 to 5% times the credit card outstanding debt times 12. And pardon me, not times 12. This is monthly, just monthly. If you're doing an annual, that would be times 12. But because this is matched up to the monthly, 3.5 to 5 in that range times the outstanding amount. Okay, let's refine this even more. Sharpen the pencil even more. Some consumer lenders, pardon me, will even look at the credit report for Bob and Sue. And if there are some substantial credit cards, like, relatively substantial, where there's a limit of 20,000 or 30,000, some consumer lenders will even look at and let's say there's zero owing. They use their credit cards, but they zero them out each month. They pay them off each month. And on the credit report, it just says zero balance. There are some consumer lenders that will even put a factor. And of course, there's no minimum payment, on the credit report because there's nothing outstanding in that case. But they'll use the old 3.5 to 5% rule of thumb against those dollar amounts, even though there's nothing owing on the credit card. Questions on that? Questions? Kirk, does that make sense?
It does, but it doesn't sound reasonable because
That's what I was just going to say. I don't know if
because we do the
that.
same thing. We do the
Right.
same thing. I mean, we use credit cards.
Yeah.
My wife.
I know. And that's
$3,000
the
a month.
and-
I'm $1,000 a month, and we.
I
pay
know,
it
and a lot of consumer borrowers, will, use their cards and they pay it off. They use the cards, but to be conservative, some banks, some consumer underwriters will do that. My observation is that most consumer lenders today, because more often than not on the credit report, you see the minimum payment due, they just take that, they're done. Here's another version we need to talk about. a consumer lender has Bob and Sue fill out a loan application, a loan app, and they list their debts, well, and their monthly payments. Some consumer lenders will go off the loan app because in their mind, it's more accurate than even the credit report, because credit reports can be accurate and cannot be accurate. Is that true, Michelle?
Yeah.
You know that. Kirk,
Yeah.
is that true?
Absolutely.
Absolutely. So some lenders say, well, we'll peek at the credit report, but we're going to go off what they put on the loan application. The challenge with that is if Bob and Sue miss one or more of the loans, whoa, then they're off a little bit. Okay, now let's move forward. Look at the 43%. That's the standard. Most banks will not go above 50, even with an exception. I've seen in my career, highest I think I ever saw was 55, and it was like a major exception. But most banks today, 50%. Okay, now.
One question. Sorry, David.
Go ahead.
I understand the different percentages. I understand everything you covered. What is the industry standard for just the mortgage?
Okay. Let's off to the side or somewhere at the bottom, whatever this page. Let's shift from traditional consumer DTI to mortgage, because there's a difference.
Right.
An excellent question. The consumer version is what we just covered, and it's really considered the combined DTI. Now, we usually don't call it combined from a consumer lending standpoint, but that's what it is. What do you mean by combined? Well, in our example, our make-believe example on the top right-hand side of this page, we combined the house payment for Bob and Sue and the first auto loan and the second auto loan divided by their gross household monthly income. Well, down at the bottom of the page or wherever you can fit it in, mortgage lenders will oftentimes do two of these DTI calculations. The first calculation may be the combined, like we just did, the combined house payment and the two auto loan payments divided by the gross household monthly income. And the max, of course, standard is like, say, 43%. But they will also, I would add this to your notes, they do a second DTI, which is called the house DTI. And they take the house payment only, which in this case is $2,000 a month, divided by the $6,000 or 33%. So they look at both. They look at because they want to see the combined. Well, with all of their debts, boy, how leveraged are they versus just the proposed new house payment, just that payment divided by gross household monthly income. As I mentioned, nationwide, the combined typically 43 max. With it's just the house payment, typically 36 to 39%. I saw a bank just recently where they said, well, we go up to as high as 41 or 42, even on the house payment. But most keep it lower. Most underwriters, 36 to 39. 33, ooh, that's good. The combined is up there. The combined is 50. But the house version of the DTI, debt to income ratio, is conservative, is low. Does that help, Kirk? Does that help?
That's perfect. Yeah, that's what I was
You
wondering
bet. Okay, now moving on to number 3 and 4. What if going back to consumer? Because what we're doing today is primarily consumer, but no problem adding with our class, no problem adding mortgage, adding even a little bit of commercial, because you both work in all of those realms. Okay, now, what if you did have this new auto loan for Bob and Sue, and it pushes their DTI, their combined DTI, to 50% max? Okay. Wow. But they've been with you for 15 to 20 years. They're never on the OD report, overdraft report. They never bounce a check. They're good borrowers, and they've got substantial savings in your bank. And you're going like, wow, I'm going to go in for an exception. I know it's a stretch to go up to 50. I may get turned down, but I'm going to go to my boss, my team leader, credit administration, whoever. Under number 3 and number 4 are 2 areas that we can use to approach the powers that be to get this approval for this exception. Now, besides, length of time in the bank, besides, they're not on the overdraft report on their checking account. Number 3, they've got, substantial deposits in the bank. Even number 4, not only have they been with us for 15 to 20 years, they've had other loans with us, all paid as agreed. These are 2 major criteria besides those other areas: discretionary income and credit score. What is discretionary income? Well, using the math we used up above, it's the $6,000 gross household monthly income minus their set monthly payments. Pardon me, the $3,000, which leaves $3,000. 6 minus 3 gives us $3,000. That's okay, but not that much. I put in your notes example. What if the discretionary income was $7,000 or $8,000? Now we're talking some more dollars. You go in for the exception. Now, obviously, these 2 are the major underwriting exceptions. And then, of course, you pull out, well, they've been with this 15, 20 years. They're never on the OD report, don't bounce checks. Oh, in previous loans with this, they've always paid as agreed, da, 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 da. Discretionary income is huge. The second one is number 4 down below, their actual FICO score, Fair Isaac Corporation, their credit report, their credit score. Most Americans have a credit score. The scale is a low of 300, the high is 850. Okay. I need you to, Kurt, Michelle, take a moment. Don't look on your phone. Just take a stab at this. Take a stab at it. What is the average American's FICO score today? The average person in America, what would you say their number is roughly? You can even do a little bit of a range, like within 10 points or 10, a leeway, a little bit of a range if you'd like. What would you say? Don't look it up. Don't look it up on your phone. Don't look it up on your computer. What would you say the average American's FICO score is as of today? Just write it down. Take a stab.
That's a good question. I have no idea.
I love it. I love it.
I'm going to throw a number out there. It might be.
Go ahead, Michelle. What's your number?
65.
Pardon me?
65.
Well, okay, it's 300 to 850.
Oh, I'm looking at, okay, I'm thinking about.
Oh, no, not the DTI. We're talking credit score on the number 4. I'm sorry, number 4.
I'm sorry. Okay, so 650.
650. Okay, 650. Kirk, what would you say?
I would guess lower than Michelle. I guess I'm more of a pessimist. I would guess 550.
550. The average FICO score today is 700 to 710.
Oh, wow. That's great.
Yeah. That's okay. This is what I'm saying. In fact, a couple of months ago, it was like, I looked it up. It was 711 or whatever. Now, the average FICO score today is higher in America. The average person is higher than in the Great Recession back in 08-09. Now, in fairness to all of us back in 08-09, the scale has changed a little bit, meaning the formula's changed a little bit. So today, it's not as conservative, the mathematical formula. And I don't have the mathematical formula, and FICO doesn't share that with the world. That's their proprietary model. Kirk, that's like you sharing all of your tricks of the trade with some competitor that tries to grab the business from one or more of your regional banks, right? Does that make sense? That'd be crazy, right?
Correct.
So, but from what I've seen, what I've read is the mathematical scale changed somewhat between 08, 09, the Great Recession era, and today. So it's not really apples and apples. It's a little bit of apples and oranges. So I'm just going to throw out a guess. In the Great Recession, it was, boy, 680, or even it got down even lower. Well, I suspect instead of 7 to 710, if you matched it up, probably be 680, 690, something like that. Let's say that Bob's FICO score is 780, though, in today's scale, and Sue's is 810. Ooh, those are high. You present these to the powers that be. Strong discretionary income, strong FICO scores, besides the other kind of ancillary, how long they've been with the bank, their deposit relationship, how do they handle their checking account, and even previous loans with your bank. Moving right along. Capacity, cash flow. Now let's go to model number 2 of the 5 C's. Pardon me. Capital. Now these others will go much quicker because they're not as boy, that first one, for especially for underwriters, they've got to get those numbers right, because that's the ability to repay. Capital, debt versus equity. You see under B1 equity in the deal, off to the right, all 3 of us remember this saying, skin in the game. Michelle, do you remember that saying? Yes, put that in your notes. Off to the right, skin in the game. It's an old saying from way back. We want Bob and Sue to have skin in the game, equity in the deal. Okay, right below auto loan, I'd put 35,000 again, 75 for the RV, please, and HELOC 100. We want them to have skin in the game. Now, periodically, Michelle, your bank would do 100% financing. Kirk, your clients, your regional banks, they'll do 100% financing on the auto loan, for example. Maybe even on the RV, but definitely the auto loan. But generally, we want something down, 10%, 15, 20%. And the HELOC, we're going to look at the formula in a minute in Model 3, but they've got to have enough equity in the house besides the first mortgage and our second mortgage. Okay, before we leave this model though, what is the source of the equity for the auto loan, the RV, and the HELOC? Any idea for the auto loan? Where does the equity come from? Where does the skin in the game come from?
Down payment?
Put it down. Put down payment from cash savings, traditionally. RV loan, down payment, cash savings. And the HELOC, of course, is the equity in the house. There's got to be sufficient equity or we can't do it. Or instead of doing 100,000, maybe we can only do 50,000. Wow. They may have the ability to repay, meaning cash flow, meaning capacity, but they may not have the equity to support it. Let's move to Model 3. Turn to page 15. Model 3 of the 5 C's of credit. Collateral, assets pledged to support the loan. Okay. Michelle, will your bank ever do 100% financing on auto loans?
Yes, we just talked about that the other day too.
You just talked about it.
Yeah,
Okay.
I know.
Okay, let me ask it. Are they new or used automobiles?
New only.
They've got to be new. Almost every lender will only do new.
Mm-hmm.
Can they be a lower end vehicle, or do they have to be a higher end vehicle? Like nothing wrong with Kia, but a Kia versus a Tesla.
I got my notes right here. Hold on a second.
Hey.
No, there is no, but we do have 100%, it's actually 100% of purchase price or value, so that if it is a lower end, we go with the purchase price.
Okay.
So it's an and or situation.
Okay, good.
Does that help
Oh,
explain
yeah.
that?
No, that helps. That helps. Kirk, in your world, yours is primarily mortgages, but you have commercial loans. Do you have, I can't remember, are any of your regional banks that your clients, are they heavy ag or not, no ag?
If they do ag, I'm not familiar. I'm not involved in that.
Gotcha.
But they
But
do
you
autos.
definitely know mortgage because of the support you provide. Commercial, definitely,
Yes, and autos, yeah, of course.
and autos as well.
Yeah.
But you're not, are you familiar with what's the max loan to value or LTV for the auto loans?
Most of my banks do 100% financing on new cars.
New only. Got it.
Which,
Okay.
which, by the way, just it doesn't really matter because we're not going to change anything. And I'm just a guy in like Commerce, Michigan. But if you're going to do 100% financing, you'd probably be better. You'd have less risk if you did it on a used car.
Really? Wait,
Yeah,
wait. Are you
as
talking
soon
about
as you
because
drive
of
the car off the lot,
are you
it's
talking about
half
because
the
of
cost.
the current market, Kirk?
I'm just saying that once you drive a new car off the lot, it loses 30% of value that day, right?
Yeah, that's a good
Yep.
point.
You're
That's
right.
that's actually a very good point. Plus, today we've got a kind of a weird auto market because of the lack of the chips or whatever, for the automobiles. You've been involved in the auto industry for years, but at least in Vegas, you go to the auto dealers, they're used vehicles if you can even find them, and the prices have just gone through the ceiling. I
Right.
have CFO clients that are going to dealerships selling their trucks for $3,000 to $5,000 to $7,000 more than they bought it for, and they drove the truck for 2 or 3 or 4 years.
That's nationwide, by the way, David. It's
Okay.
not just your area.
Not just Vegas, not just our area. Wow. Amazing. Let's go to RV. Most banks today, 75, 90. I'd slash through the 90 and put 85. Most banks today, Michelle, do you know in your world, I don't know if you've had the discussion on this recently, but what's your maximum loan to value or LTV on your RV loans?
I'm looking right now on our master sheet because I don't do it every day.
Yeah.
So that would be considered a mobile home?
No, not a mobile home. These are actual recreational vehicles. But I mean, they can be the big ones, they could be the toy haulers. They could be all different versions.
It could be a Class A, but it could also be a motorcycle. It could be a boat. It could be a
Okay, so that's in the same category as our auto loans.
Oh, okay. Okay, got it.
That's why I had to have the clarification.
Oh, you bet. Yeah. The 75,000 we're using today is just to give us a feel for, kind of the level of the RV loans I used to loan on from that manufacturer. They weren't those Class A, Kirk. They weren't those, in today's terms, 300, 400,000 plus RVs, but they were, they were more, they weren't the junkers either, 75, 100,000, whatever. Home equity loan, line of credit. Most banks, when it comes to loan to value, LTV, 75 to 80%. Now, let's clarify. We take mathematically to the right of that. I put this in your notes, please. We take the balance of the first mortgage on the house combined with the proposed second mortgage, home equity loan or line, and we combine those two numbers together, divided by the fair market value or appraised value of the house. And that max loan to value today, 75 to 80%. Now, a few years back, before the pandemic, so forth, some banks were pushing even 85, but I've noticed most tapering back to 80 today. Okay. Michelle, can you read us from your chart what's your max loan to value, which combines, once again, mathematically, the first and the second combined, divided by the appraised value in the home. What's your max underwriting standard? Do you have that on your sheet?
No, but I think I got another place I can look, because I'm
Okay.
curious too. You're making me look into this stuff here.
This is good though, Michelle, because boy, this applies to your world, and Kirk, to your client's world. When you're talking to them, it's like, well, I took this class, and what are you guys doing on this? We're doing this, we're doing that, whatever.
Say the question again, because I don't think I've got the answer.
Yeah, if you're in your underwriting standard,
Right.
what is the maximum loan to value, or LTV, for the home equity loan or line? And what you do is you take the balance of the first mortgage plus the second mortgage combined, and divide that number by the value of the home, the appraised value of the home.
Okay, I found
Usually
it.
on your rate sheet, it will show on maybe not your rate sheet, but your underwriting sheet.
It is. It's on our underwriting, not on our rate sheet.
Not your rate sheet. Yeah, I said that wrong. It's not rate sheet. It's your underwriting sheet.
So we will go 60 to 80 is considered acceptable. Below, over 80 is considered. Yeah.
Okay, so 60 to 80, 60 to 80%. Good. And
Yeah.
like I said, a few years back, a lot of banks were pushing 85. But now, even though real estate is strong, most banks, about a year and a half before COVID hit, a year maybe, most banks were anticipating, our industry was anticipating another recession, not a great recession, but you may remember a few years ago, a recession. And way before we ever heard of COVID, within 6 months, a year and a half before, our industry started to kind of pull the reins back a little bit. So on, like, for example, the home equity loan line, it was more like 85%, and then they started tapering down to 80, thinking that there was going to be another recession, regular recession, not COVID, a pandemic, and so forth. Okay, now let's look at, because we're on collateral, this is a huge area to consider. Purchase money versus refi. Okay, what is a purchase money? Purchase money is where Bob and Sue, our imaginary couple in Lansing area, they buy the RV, okay? And they buy it, and you finance the purchase.
Right.
You as a creditor have the superior rights as what is called, and I put right below purchase money, the word creditor.
Yeah.
You are considered what is called a purchase money creditor. This is huge from a legal standpoint, collateral. Versus if they come to you and say, well, we've got this loan at this other bank on the RV. We've had it for a year and a half. And boy, is there any way you could refinance it? Give us a little better deal, maybe a little less on the interest rate, maybe a little stretched out on the terms. If you do that refi, you don't have the superior rights as a purchase money creditor. Now, this is applied to consumer lending. Whoa, when it comes to commercial, let's just picture you are in commerce, okay, area, and your bank lends on a piece of equipment for a company, for Bob and Sue's company. Well, if your loan is used to buy that piece of equipment, you're purchase money creditor. Versus these other banks, maybe 2 or 3 other banks have lent on just kind of general pieces, general equipment, or have what's called a blanket filing, UCC 1 filing on that equipment. You go into court, and let's say there are 3 banks, your bank and the 2 others, and the 2 others are either refinance on the equipment or just kind of general filing. Your bank has the superior collateral position on that one piece of equipment that your commercial loan was used to finance the purchase of that equipment. Does that make sense, Kirk? Does that make sense?
Absolutely.
And we just talked about that too, because we just got a cute little handout regarding purchase money and non-purchase money
Yeah.
when it comes to security, because we're primarily commercial ag, and I work primarily with the commercial ag lender. So
Yeah.
there you go. He'll have his commercial people go out and buy something over the weekend because they have the equity, or they have the
Right.
commercial line of credit, or they have the ability to do so. Then they'll come in and say, hey, I want to buy this, give me a loan for it, because they might be at auction, or they might be somewhere.
That's right.
And so there's that fine hair. So,
Yes.
okay, is it considered a purchase if they already bought it?
Well, and that's tricky. The better
Right.
approach, in my opinion, to
Mhm.
protect your bank
Mhm.
is let your bank wire the money to the vendor, to the manufacturer.
But what if they've
whoever.
already bought it?
Well, then
That's the problem, because usually they're
I
in
know.
a situation where they want it, and they want it right now.
I know.
And so
But it
we
is
just
different,
had,
though.
go ahead.
It's different in real estate though, right, David?
Yes, yeah, that's different. This is quote unquote personal property.
Right. Personal property.
Automobile, RV, that's personal property. The piece of equipment from, a company in Commerce or in Pigeon, but a piece of manufacturing equipment, they're a small manufacturer, specialized piece of equipment, that's still considered personal property versus real property. Real property is the home equity loan line, or the first mortgage, or second even on the commercial building. Totally different set of rules, if you will. Yeah.
Because I just pulled it out because I'm like, wait a minute, we just talked about this too. It's
Yeah.
like everything's coming into
Purchase
play.
money, you bet.
Because
The preferred is for your bank to be a purchase money creditor, generally speaking, with personal property. Now, that doesn't mean it's always consumer. It could be business owned, but it's considered personal property versus quote unquote the other class of collateral property, real property, meaning real estate.
So what they decided, because we have a lot of that here too, like our commercial lenders will go out and buy a car for their kid over the weekend, and then
Yes.
come in and want a consumer loan.
Yeah.
So what our new practice is if they've come in and talked to the lender, and we've done the application, and they
Yeah.
said, hey, we're looking.
Yeah.
We're looking, and this is what we want. As long as we have that in place and that happens, we can still do it as a purchase money, because if we run the credit.
This is jumping ahead to documentation, which we'll cover later, but let's just say it right here. And I would put this at the bottom of this page, whether it's consumer or especially commercial, like the equipment for the farmers in your market, or Kirk, your clients on the commercial side, you want to make sure that the security, it's called a commercial loan, it's a commercial security agreement. So it's a security agreement, clearly states the description of the collateral, including the words purchase money interest, or purchase money whatever. It's usually purchase money interest in this collateral. It clearly states purchase money. Okay, I'm not saying that the opposing side, if you're in court, a year later and the other attorney and they've dug through the file, well, this was really a refinance because of the timing of the issue. You still want to put purchase money, in my opinion, to protect the bank. Good point. Good. Any other comments on this one? Let's move forward. Here we go. Page number 16, our fourth of our 5 of the C's. Before we do this, let's go ahead and take our second 5-minute break of the morning. So let's take a quick 5-minute break. We'll come on back. We'll do number 4, conditions, and number 5, character. Okay. Talk to you in 5 minutes, everyone. Thank you.
Sorry, I have one question, David.
Oh, go ahead. Go ahead before we take the break. Go ahead.
Sorry to do it to you again, Michelle.
That's okay. I'm not as desperate right now as I was the first
Yeah,
time.
no, I'm in the same boat. If I go out and buy a piece of real estate, So a single family home, I buy it at
Yes.
an auction, it's 150 grand, I pay cash for it.
Yep.
And then I go to the bank
Yep.
and say, I used cash to buy this. I bought it at the courthouse,
Yes.
whatever.
Yes.
Are they in the same situation with the purchase money versus refinance situation? Or
No,
is it different for real estate?
my understanding, the purchase money is, and I may be wrong, but my understanding is it's on personal property, automobile, equipment for the business. Real property is totally different. Real property, it's based off of, and it is like if you take a UCC filing on the equipment, there is a pecking order, who filed first and what have you. But my understanding on the real property, which includes those rental houses, Kirk,
Right.
that's separate. Does that make sense?
Yeah, because as soon as they give me a mortgage, they're going to become the first position on the
Exactly.
deed,
Right.
right?
Exactly. And that is where they hang their hat on, is the position of the pecking order. Are they first mortgage position, second, third, fourth, whatever?
Gotcha. That makes
Okay.
sense.
Yeah.
Yeah, those two
You
are
bet.
very separate when you
Yeah.
talk about real property versus the
Yep.
consumer property. Yeah.
Yep.
Good
And-
question.
and- Yeah,
Good
good
question.
point. Good
Okay.
point.
Sorry, I delayed
Okay.
the break again, Michelle.
Nope.
Not a
Talk to you in 5 minutes. Thank you. Welcome back, everyone. We'll go ahead and get started. Our fourth of the 5 C's of credit, conditions. These are economic conditions. How are Bob and Sue impacted economically? They're based in the Lansing market, local. Okay, what I need both of you to do, right next to the word local, if you'll put pigeon or commerce, regional. We're going to say the upper Midwest, national, US, international, planet Earth, the world economy. Okay, and I'm going to have you do, Kirk and Michelle, do a quick activity on this on a scale of 1 to 10. 10 is the highest, 1 is the lowest. 10 is the highest, 1 is the lowest. How would you rate your local economy? Now, these are separate ratings. So you could have, a 10, a 5, a 3, whatever. They're individual ratings. And you say, well, why are we doing this? Well, conditions refers to economic conditions. And the local, regional, national, international all have a play on Bob and Sue's ability to repay the debt. It used to be 30, 40, 50 years ago. National, international, not so much. But today, with the world connected with technology, with communications, even more so. Okay, take just a moment and make a judgment call. What would you rate? 10's the highest, 1's the lowest. Local, regional, national, international. Go ahead, please. Pardon me. What would you say?
That's a tough one too.
Okay, Michelle, we'll start with you. What did you say for local? What number?
I gave that the highest rating.
What number?
10.
10 all the way.
Yes.
Kirk, what would you say local in your area?
I said 8.
8. Kirk, what did you say for regional, upper Midwest of the US?
It's 6.
Michelle, what did you say for regional?
You caught me. I dropped my pen. I'm sorry. For the regional?
Yes.
I gave that a 8.
Okay, national. Kirk, what would you say for national?
I put 4.
4. Michelle, how about national?
I gave it a lower rating too. I gave it a 5.
Okay. Michelle, planet Earth international.
It's pretty parallel to the national, but a little bit lower, so 4.
Kirk, what about international?
I went all the way down to 2. I figure with the war and everything else going on, I would rank that lower.
Okay, thank you. Every one of these have an impact. Okay, 2 other concepts we move forward. At the top right-hand side of this page, if you'll please put this little saying. A bank is the mere reflection of the economy in which it operates. A bank is a mere reflection of the economy in which it operates. What does that mean? Well, let's picture, just as a classic example, Eastern Kentucky, small coal mining town, one coal mine, the most major employer in the market. A few, half a dozen or a dozen small businesses, but that's about it. And one bank. The coal mine has a cave-in. No one gets killed, thankfully. But there were some injuries and the mine is shut down by OSHA or whatever for 4 or 5 months. How quickly, Michelle, will there be defaults on the loans at the local bank?
Huge, because usually that's the primary income of the area.
Exactly.
If they're not getting an income or they're getting less of an income or whatever, how they're affected, that's going to affect them.
Exactly. Exactly. So the bank is a mere reflection of the economy in which it operates. Second item, look at the very bottom. Kirk, you remember this? Kirk, in your business classes, you had economics, right?
Yes.
So you may remember gross domestic product, GDP for short, which is defined as the annual output of an economy within a given year. The annual output of an economy within a given year. Well, the largest component component part mathematically of this formula is consumer spending. In fact, it's designated with a large C, capital C. What supports consumer spending? Consumer lending. Actually, I'd add mortgage lending and commercial lending, because mortgages tie into the consumer, companies tie into the consumer ultimately in most settings. Consumer spending is the biggest. And our bank, or Kirk, your clients support that part of the economy, that part of that concept of GDP. Let's move forward. Our fifth and final of the 5 C's, the fifth and final, character, willingness to repay. We talked about FICO score. Okay, I'm going to ask you, don't tell us specifics, but have you ever seen an error on your personal FICO score credit report? Michelle, have you ever seen an error ever?
Yes, I had to battle with the credit companies to get it, or I had to go back to the original company that put it out there to get it remedied, and it's a pain in the rear.
Good. That's a good example. No, I'm sorry you had to do that. Kirk, what about you? Have you ever seen an error?
Yes, it was through like a $35 copay thing.
Yep. I saw an error once, and Michelle, like you, I tried to fight it. Oh, they basically told me to take a hike. And you know what they told me? And it was a small dollar amount. I know, a couple hundred or $500.
But it still affects your credit score, even if it's a $2 thing.
Oh yeah. And I literally called the company and proved to them that it was an error. And the person on the other end of the phone, she says, in so many words, it's only $500. Why are you making such a big deal? And I said, well, because it's impacting my credit score.
Right.
And her attitude was, well, we're not going to do anything about it. We'll see you. Bye. I could not, but I was like, what?
Mine was similar. I had a credit card that we paid in full, and the couple of days, there's that day gap, and it was under I think it was like $2.15 or something was the difference. And we had paid it in full. It was an appliance purchase, and they put it on the credit report that we did not pay $2. It was like stupid amount. And we had purchased numerous things from them throughout the years, and they wouldn't forgive that. And we didn't get the notice, and it ended up on our credit report.
Wow.
And we were so angry the credit report was cut up, or the credit card was cut up, and we told them we wouldn't be doing business with them anymore.
I love it.
We were so offended that hit our credit report that way.
It happens. Mm-hmm. Okay, we're going to do a quick activity. I'd like each of you to look at number 2, A, B, and C.
Okay.
What are some other things you can do or look at besides the standard credit report to determine, or at least to get a read on the character, their willingness to repay the loan? What are some other things you can look at? I'll give you a hint. One is factors of stability. Wow. Go ahead, spend just a moment. 2A, B, C, just write down a few thoughts. What are some other things that you could consider besides some lenders become very myopic when it comes to character, and they look at the credit score like as if the credit score is perfect. And I'll say to them when I'm training them, I say, well, but credit reports are often not accurate. Mm-hmm. I've had a few lenders, and usually they're junior lenders, they're newer lenders, because not always, but some junior lenders get this attitude like the FICO score is literally perfect and there can be no errors. And when you say, well, no, there's errors all the time, they look at you like, no way. And they look at you like, well, no, literally, it is literally always perfect. And I'm going like, what? No. Go ahead. Go ahead. Spend just another moment on this one. Number 2, what are some other areas we can look at? Okay, Kirk, what's one other area you could look at besides the traditional FICO score, the credit report?
If they're a homeowner,
Good, homeowner. Now, we cannot be prejudicial, homeowner versus non-homeowner, but the length of time in the home is a legitimate. So this gets a little tricky because I know traditionally we think, well, renters a little flakier than the homeowner. So we cannot use home ownership, but length of time of residency. Michelle,
if they've been renting for years, that wouldn't really, I mean, if they're renting and they're having no problems with paying their rent on time, that would be something that you could consider, right?
Exactly. That's what I'm saying. You know, okay, Kirk, you have tenants, right? Not to pry, but you have tenants, right?
Right.
Or used to. Okay, well, do you have any tenants that have rented from you for more than 5 years even?
I've got one that's right around 4 years.
Okay, 4 years. There's stability. That's good. So technically we cannot, typically we say, well, are they a homeowner or they rent? But from a consumer loan standpoint, no, it's just length of time in residency. Let me give you an example. I'm going to talk out of the other side of my mouth. An unwritten rule of thumb in Las Vegas. Now, this is commercial lenders, not consumer, is that if the business owner does not own a home in Las Vegas and lives in that home, because a lot of people have second homes in Vegas, just like other parts of the country, but especially like Californians, a lot of time they do it to get around the tax, the huge tax in the state of California. So they set up residency in Nevada where they don't really live here. They still live in California. Well, unwritten rule in the banks in Vegas, you will not get a commercial loan unless the owner of the business lives and actually owns a home and lives in Vegas. Now that's a commercial loan, not a consumer loan. And the reason why is because we're a very transient town. People fly in, people fly out, people move in, people move out. So would a bank ever disclose that to the public? No, but that's an unwritten rule of thumb with commercial loans, not consumer. Moving right along.
So David, real quick,
go ahead.
Real quick on that. We
Yep.
don't report to the credit bureaus, and nor do we pull credit reports with the score. So
Really?
our lenders really have to detail and look through a credit report because we're not given a magic number.
Wow.
And yeah, we're a little off the beaten path in that way, and they've been that since the day of inception. We've been in business for 125 years, so
Wow.
it's just what they do. So the lender has to be able to read a credit report and understand a credit report because they don't get the magic score.
Got it. Interesting.
One of the things that I hear the lenders talk about all the time when they're looking at, of course, they're looking at the total credit card debt. They're looking at the number of late pays or anything that may have been charged off or something to that effect. But they also really heavily look at their previous history with us as a bank.
That's a common one.
I mean, that's probably one of the top ones I hear them say is, what is their history with the bank? If they're a longtime customer, we tend to weigh that in that whole decision-making process.
Good. Excellent comment. Now, that's going to tie us into this one. This page number 18, this is called the SAW model. I'd highlight SAW model at the top left. This is an alternative to the 5 C's. Some, most all lenders, I'm familiar with the 5 C's. But SAW, well, look at this. I would circle or highlight the S for stability, A for ability, W for willingness to repay. Look at the stability, length of employment, length, the type of employment, length of residency, whether or not they own, because this is consumer focused today, lending. Look at ability, debt to income, DTI, willingness to repay, credit score, character, and so forth. Now, if it's a business borrower, let's shift to the business borrower for a moment. Commercial lending, I would put under willingness to repay, business reputation is legitimate. A lot of people don't realize this. Consumer lenders are very focused on, compliance, being equal, and so forth. And I'm not saying that the commercial lender isn't, but the commercial lender can use, under the willingness to repay, the reputation of the business as a legitimate criteria, as long as they do not violate the compliance regs we'll talk about later in our session. Meaning specifically Equal Credit Opportunity Act, Reg B for short.
Excuse me.
Prohibited basis, race, creed, color. We'll come back to that later in the day in our session. So reputation. Now, let me ask you this, Kirk, in your marketing to your clients, do you ever look at the reputation of the regional banks or other clients? In other words, you personally or your team, as far as should we do business with this group?
The answer to the question is no, other than number of mortgage loan officers.
Got it.
So when our system is heavily weighted towards mortgage, right? It's just
yes.
There's a lot of revenue comes out of mortgage.
Heavy on the mortgage, you bet.
And then the nice thing is that by using the mortgage system, it actually cross sells other bank services, right?
Yes.
So we don't look for like Google reviews of the bank, but if they don't have at least 10 mortgage loan officers, we don't think they're serious about mortgage.
Gotcha. Yeah, they're not big enough. They're not stable enough. They're not, like you said, they're not serious they're not in the game, right?
And years ago, when we first started doing software for banks, there was a bank in Michigan on the east side, and they had one mortgage loan officer, and we signed him up, and then the loan officer quit. And then it's like, okay, well, we have a 2-year agreement and it automatically renews. And they're like, well, we don't have a mortgage loan officer. I'm like, I'm sorry, you got to keep paying me. And then it was like, it was a bad deal for them and us, right? Because we were generating leads that nobody was calling on, right?
Yep.
And they didn't have a mortgage loan officer replace the one that left. So we've just come to the conclusion of like, if they're serious about mortgage and business revenue and growing their business and growing their mortgage business and cross-selling all their other services, they're going to have at least 10 mortgage loan officers.
You bet. You bet. So once again, what you're really looking at is you're looking at these banks or these mortgage companies really to a certain level of stability, if you will, right? Would you agree with that? I mean,
especially
stability.
in the mortgage industry. Yeah.
Yeah.
Stability is a good point. Yeah.
You bet. Now, one other alternative. This is the first alternative. Here's another alternative to the 5 C's of credit. It's called the 5 D's of credit. What? Okay, now I'm going to say this straight up front for everyone. This is a spoof. Okay, Michelle, this is a spoof, right? This is a spoof. This is tongue in cheek, right, Kirk?
I don't know. I'm worried about D.
Okay, now, where did I get this from? A few years back, I was training in a large credit conference in Kansas City. And it was a breakout session, and we were going through the 5 C's of credit. And a lady in the back of the room raised her hand and goes, you got it wrong. And after we were almost at the very end, and she goes, I said, any questions, comments? And she raised her hand. She goes, you got it wrong. It's not the 5 C's of credit. It's the 5 D's. And we're going like, what? And everyone looks at her and I look at her and I said, well, what are the 5 D's? And then she rattled these off and everybody bust up laughing, including myself. Well, these are criteria that are very sensitive. It's tongue in cheek, a play off 5 C's, 5 D's, but there's a lot of truth to it. Drink. You have a client with a drinking problem, drug problem. Dudes and dames gets into the personal relationships, divorce, and even death.
You can't use those. Those are not criteria.
And you cannot use those. You cannot use these. Would you agree, Michelle, from a compliance standpoint, there is not a litmus test for, or are they an alcoholic? Would you agree?
I agree.
But at the same time, is this a true statement, Michelle? With the lenders in your bank,
Yeah.
behind closed doors, let me just ask it this way, Michelle. Have you ever seen any of these items come up behind closed doors in open conversation with your lenders?
We live in a small area, so we know a lot about people. Unfortunately, that makes it a little bit more challenging. But yeah, there's been discussion, but we can't use that.
I agree.
As the reason for denying a loan. We have to basically work really hard to try to figure out if we can even do the loan. Exactly. We have to look at it from the opposite side.
Yes. But if you have a client that has a drinking problem, is this a true statement, Michelle? The lender says, oh, we're not going to make a loan to this guy or this couple or this lady or whoever. But they don't use that obviously as the reason for the decline letter, correct?
Correct.
But internally, everybody knows what the real reason for the decline was. Is that a true statement, Michelle?
Yes, that is a true statement. I would say we all pretty much know why things happen the way they do. Yeah.
Exactly.
Small community.
Okay. Let me ask you this, Kirk. Thank you. Kirk, in your world, dealing with those 160 regional banks, mortgage lenders, and so forth, are there now their criteria board, the 5 C's or the SAW model? It's got to be just straight up and down, especially in the mortgage arena. If it's going to be, all the, FHA or VA or whatever the product, none of these can be included. But do you think these are ever indirectly included in their underwriting?
I'm gonna guess because Michelle said so, yes, but
Okay.
I've never had any of the 160 banks ever bring any of this up. Like this is the first time I've ever heard of 5 Ds. And ironically, my commercial banker gets me a big bottle of liquor every Christmas. So
I love it. I love it.
He knows I don't have a drinking problem, but he knows I drink a nightcap almost every night to help me go to sleep. So I don't think he's ruling me out because I like scotch.
No, I love
well,
it.
There's a difference between, you have to remember, most of the lenders like to drink themselves. There's a difference between someone who just enjoys a beverage to someone who has a drinking problem.
Right.
That's a good point.
And usually when you have a drinking problem, it affects other facets of your life, which in turn, we don't have to use that as the reason. It just kind of, it snowballs down. So there
exactly
you go.
Right.
We all know why the snowball effect happened, and it's because of the 5 Ds.
That's it. Good. So this is tongue in cheek, but there's a lot of truth to it. A lot of truth. Let's move forward. Page number 20. We're going to stop right there and take our lunch break. Okay.
Okay,
so now,
full disclosure, David, today's a birthday and the lunch isn't here yet. So I may very well be chewing on my lunch while
no problem.
After we come back. So full disclosure.
No problem. We'll take our lunch right now because it's about 12 noon your time.
That's fine.
But no problem. If you want to
drink,
eat, doesn't matter. You can drink a cup of coffee, whatever. So good.
All righty.
Okay, excellent. Well, let's take our half-hour lunch, come back around 12:30 your time, and we'll continue with the saga. With our next step, the lending process, which is A to Z. We're going to include a lot of what we already covered and insert it in this process, and then a lot of additional information. You bet.
Okay.
Thank you. Talk to you about 12:30. Thank you. We'll see you. Talk to you in a half hour. Welcome back, everyone. We'll get started in just a moment. Get started in just a moment when everybody gets back. Pardon me. Okay, here we go. All right, Kirk, I can see you. Can you hear me? Okay, great. No problem. Okay, here comes Michelle. Excellent. Okay, let's see. All right. Okay, Michelle,
I
can
apologize. My
no
computer
problem.
froze up and I had to reboot.
Oh, no problem. Can you see me turn the slides, Michelle?
Say that again?
Can you see me turn the slides?
No, I'm not seeing any movement at this point.
Okay, it's doing that again. Hold on one second. Okay. Okay, can you see me turn the slides now?
No, nothing is happening.
Okay,
I-
hold on.
You gotta go back to presenter mode.
That's it.
No.
Okay. Okay, hold on one second here.
I didn't make you wait too long, did I?
No, you're okay. Okay, hold on one second. Can you see me turn the slides now?
Yes.
Yeah, but you still don't have it in presenter mode.
Okay, how
See
about,
see the little icons down at the bottom? David,
uh-huh,
bottom of PowerPoint. No, up, up, up a little bit. Okay, over to the right, right above the letter Y in Sunny. There's a little icon there. It's
wait, and you're saying in where at? Right there?
Yep, right. Yeah, just go 3 to the right and click that one.
Says remote control.
No, so at the bottom where it says click to add notes, okay? All the way over to the right, you see like one of the areas is highlighted. It's on the PowerPoint. It's on
Oh, the PowerPoint itself. Okay.
no, at the bottom.
Okay.
Bottom.
Oh, add notes. Uh-huh.
Yep. Okay, now go to the right.
Uh-huh.
Go to your right. See how one of the little icons is highlighted?
At the bottom right-hand corner of your window, below the note section,
Okay, hold on.
Yeah.
Yeah.
right?
Okay.
Okay. You want to click on the one that's 3 to the right.
Reading view, no slideshow.
That one.
That's it. Okay. Now can you see it?
Yeah.
Yes.
Oh, right. There we go. I can't see it on mine. I can barely see that. Okay, got it. Okay, let's continue forward. Here we go. Page number 20. The consumer lending process. Here we go. A to Z. We're going to start with direct versus indirect lenders. Direct lenders are those individuals, pardon me, that will you have within your bank that interact with Bob and Sue, our imaginary borrowers. Indirect, you may have an indirect consumer lender. They're behind closed doors. Their clients are actually like the auto dealers in town. So they don't interact directly with Bob and Sue. What they do is they work with the finance managers at the auto dealerships. The finance manager will pull the credit, will take the loan application, pull the credit, even calculate the DTI, debt to income ratio. And then they package the deal, scan it, and send it to your indirect lender. And so what the term is that the indirect lender, consumer lender, is buying the paper. They buy the paper, if you will, from the dealers. And they may say, well, we'll do this loan, and then they get the next one. And they're just coming across the screen basically all day long. Many indirect lenders may have, depending on the workload, 5-10 minutes to make that decision. Look through the file, make the decision. We're going to buy this one, meaning we're going to fund this loan and not this loan. Very similar, Kirk, to the world of mortgage lending in that once that loan is originated, it's sold in the secondary market. Kurt, do you have clients in those regional banks that do that play, if you will, or lend into the secondary market?
Absolutely. Most of them do.
Most of them do. You bet.
Yeah, Fannie, Freddie, or United Wholesale.
Fannie, Freddie, all of those. Good. Now, Michelle, let me ask you, do you have any indirect lenders at your bank?
Not
or
at
is
all.
it
No,
it's all direct
face-to-face.
because you're small bank, 4 branches, it's all direct.
Yep.
But as your bank gets larger, traditionally, you'll have the indirect.
Right. We
Okay.
do. We all face to face with customers. There's not one of us that does an indirect.
Okay.
Yep.
Thank you. Under Part B, other types of financing within the consumer lending arena. Floor plan financing. You go to Lowe's, you go to Home Depot, you see a big ad, this coming Saturday, you have a big ad. It says, all appliances on sale, package deal, da, 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 da. Floor plan financing.
Is that what you use for auto dealerships too? Because it's not floor plan. There's another term.
You could have it. You could have it there in an auto dealership. Now that's oftentimes where the bank is lending to the dealership.
Yes.
Up above under A2, it's where your indirect lender is buying the individual contracts.
Okay.
So under A2, Bob and Sue go to the auto dealership. They say, they meet with the finance manager. Well, we'd like to finance this. Finance manager, once again, they do the loan app, they pull the credit, they do the DTI, they package the deal. They may even send it to multiple lenders, but usually they're going to work with certain lenders and they know the parameters. Well, this bank or this credit union likes this type of deal and so forth. Floor plan financing could be, but that's where, once again, the bank is financing the overall dealership. But in this case, they're financing the consumer within that walks into Home Depot, Lowe's, or what have you. Usually it's a large bank that does the actual floor plan financing for, like Lowe's, this package deal of all the appliances.
But that's not a consumer loan. That's a commercial loan, right?
Well, it's from a bank through Lowe's to the consumer.
Oh,
because
okay,
Bob and Sue walk into Lowe's and says, well, we need to replace all our appliances. It's $8,000, whatever, a big sign, OAC, on approved credit. Well, they fill them out. They fill out the forms. What they may not realize, who's actually funding this loan is this some big bank, B of A or Wells Fargo or Chase or whoever.
I got you now. I was confused. My brain went with the bank, the commercial side of
no problem. Leasing, consumer leasing on automobiles. Kirk, what's your opinion on those? Is that a good deal from the consumer standpoint? Can it be a bad deal? What is your thought on B2?
Well, my personal opinion is that nobody should lease cars. Okay. But there are people that have really nice cars, Mercedes, BMWs, Corvettes, Cadillacs, and they also lease like a beater car.
Yep.
And they'll drive their beater car, they'll lease it for $200 a month, and they'll drive their beater car back and forth to Detroit, 45 minutes each way. And at the end of the lease, they turn it in, and they're keeping the miles off their nice cars.
Yeah.
So I'm guessing in some cases it makes sense. In most cases, I think people lease cars that they can't afford to buy, and I think that's just a bad idea.
I agree. Generally speaking, in my opinion, a consumer auto lease is a mistake because you get into this and you're paying your artificial low payments for 3 or say for 3 years, and you say, well, the lease is done. Well, hey, and the bank says, well, we'll finance the remainder and part of the contract. Oh, it's another 2 years for a total of 5. Oh, no. It's another 4 years. Well, wait a minute. That means I'm into this deal for 7 years. Well, the payments for the first 3 years were artificially low on the lease. There are situations though, pardon me, from a business standpoint that it may make sense to lease. From a business perspective, tax-wise, the lease payments are tax deductible. They're not for the consumer. So the consumer can get, in my opinion, eaten up alive. But for the business borrower, commercial borrower, sometimes it may make sense. They, for example, a big law firm, the senior partners of the law firm, they all get brand new cars every 2 or 3 years. Well, they're getting the write-off. It's a perk to them. The firm's getting a tax break and so forth. That may make sense. But for the average consumer, no way.
I find that curious. I leased my first vehicle ever in my life this last time. And now with COVID and the low supply of used vehicles, I'm seriously contemplating purchasing my lease.
Whoa, now that may make sense because we're in a like we talked about before the lunch break, we are in a very unique scenario with automobiles today.
Right. And because of that, I'm like, man, I don't want to get a new car, pay a bigger monthly payment and not have my chip in it that operates the things that I want.
That's a good point. Kirk, you had a comment.
No, I just, another downfall of leasing is that you've given up the control. Right?
Yeah.
So like on the, whatever it is, 32, 36, 39 months, you must turn the car in at that point, right? You can't just keep the car. You can't sell it early, right? So you could buy a car and have it for 2 years, and then for whatever reason, you need to sell it. You can't, right? So you've given up a lot of options by leasing a car. And what I've found is that people that get their first lease, it's $300 a month. Then the next time it's $400 a month. The next time it's $500 a month. These dealerships walk these leases up in their monthly payments over time to the point where
going up.
It keeps going up. The cars keep getting more expensive. They just keep getting sucked into another lease, and it's not an asset. It's a liability.
Oh, I agree. I agree 100%. One last comment on the automobile. Now, this is not specifically to the lease, but it's interesting. Our daughter is an interior architect here in Las Vegas, where I'm based.
I will be right back.
No problem. She was working with an auto dealership recently, Ford dealership. And the manager of the Ford dealership, and she was doing some of the redesign of their floor and so forth, their space at the actual dealership facility. And the manager at the dealership told her, and they were just talking about how crazy the auto market is today. And the manager told her, do you realize you could buy one of these vehicles on our lot, drive 5 minutes down the street to CarMax and sell the vehicle literally the next day or the same day and make $5,000 plus on the deal?
Right.
Now, Kirk, that is insanity compared to the traditional auto market. Would you agree?
Absolutely. There's no negotiating right now.
Yeah, it's amazing. Let's move forward. Page number 21. Michelle will be back in a moment. Now, loan structure. Okay, if you'll put this in your notes, auto loan, $35,000, right below the top there, right below RV, $75,000, and the HELOC, $100,000. Okay, now we're going to fill in this table together. This is the structure. We're on the panoramic or in the panoramic. Here on page 21, we're on the panoramic of A to Z, the start to the finish. We did our intro to this process. Now we're going to plug in and we're going to just move all the way from the original. You're the loan officer. Boy, you're going to structure the deal, support the deal, get approval for the deal, document the deal, close the deal, monitor and collect even on the back end. Borrower's needs, from one of our previous models over to the right underneath the auto loan, $35,000 auto loan, $75,000 RV, $100,000 HELOC. The borrower's need, of course, is transportation. So the consumer lender structures the deal. They say, well, what's the real purpose of this loan? Does it make sense? Well, for the auto loan, for transportation, absolutely. Underneath the RV, as we said earlier, recreation.
Mhm.
Underneath the HELOC, various. But the tax deductibility is limited to substantial improvement, pardon me, to the property itself. What about the type of loan? Is an auto loan open-ended or closed-end? Which
Closed.
one is it? Closed-end. How about the RV loan, Michelle?
Closed.
How about the HELOC, Kirk?
Open.
Open, good. We know the amount. I'd put 35, 75, 100. Okay, now, what about the terms? What is the most typical term you see? Michelle, in your bank, Kirk, in your world, even as a consumer borrower, what is the most typical term for the auto loan? Michelle, what's the most typical in your bank?
Well, it depends if it's brand new or not.
Let's say it's new. Let's say it's new.
6 years.
6 years. Kirk, what about in your area, in your community of commerce?
5 years.
In 5 years. The most common nationwide is 5 years. But it's interesting, Michelle, you'd say 6 for whatever's worth the bank I bank at, which is a community bank, it's 6 years.
Mhm.
Okay, what about the RV? Will your bank, Michelle, in Pigeon, will you do an RV loan? And if you do, what's your typical term?
6 years for brand new.
Only 6 years on that RV. Okay.
I believe so, but
Well, you
hold
go-
on, let me double
Okay,
check.
she's gonna check her. I call it that. I used to call it when I was on your side of the table, Michelle. I called it my cheat sheet.
Yeah,
I'd
and
pull out the
trainers
cheat
say job aids.
Yes.
Well, I guess it was however the lender would take it because our mobile homes are 63 months, but that's what the balloon, I'm gonna say it's 5 years, but I can very quickly email my lender and find out.
You bet. Okay, while you do that, Kirk, in your area, what's a typical RV term, meaning the amortization that
A
you would
lot of
see?
a lot of RVs will do 15 and 20 years.
15 and 20. Boy, 15 is common depending on the size of the RV. Now, if it's one of those class A 300,000-400,000, it's going to be pushing more the 20-year. Would you agree?
Correct. But even $100,000 boat is usually 15 years.
Yeah, good. Excellent.
Well, it
Okay.
says, when he said that, boats and large campers / mobile homes can be amortized 15 years. Got it.
15. There it is. 15. You matched up 15. Okay. What about the HELOC? Some banks, they just put it on perpetuity, meaning there's really no renewal, but they run the credit of Bob and Sue once a year, once every 3 years, they do some sort of a review. Do you know, Michelle, in your bank, how do you handle the HELOC?
We don't do HELOCs.
Oh, you don't do HELOCs?
No, we do not.
Okay. Kirk, in your world with your clients, do you know, I know you work with a lot of clients that do the mortgages and the HELOCs and home equity loans and so forth. Do you know what their typical term is?
I believe that they're open-ended, but I do believe that they probably do some review over a certain period of time. I'm not that involved. I'm glad that I got them a lead and they got a HELOC loan, but I don't know how often they're reviewing them.
Got it. Usually a lot of banks, it's once a year, real minor review. It's just a real cursory review. Other banks they may do that once a year, but then more every 3 years, do a more full review, if you will. Good. Now, what about pricing? Okay, this is going to go beyond your bank, Michelle. And Kirk, it's going to go, Michelle, in your market and in Kirk's market. what is the lowest priced auto loan you've seen in the last 2 months from now? Now, rates are increasing. They're anticipated to increase interest rates. In fact, the Federal Reserve, our nation's central bank, pardon me, has said that interest rates are going to increase. They're going to bump up the rates 3 times this year in 22 and 3 times next year in 23. But what about in the last month or two right now? What is the best interest rate you've seen on an auto loan? Kirk, what's the best you've seen in your market?
0.9% for 5 years.
Wow.
For an auto loan? For an auto loan?
Wow.
Let's see, that may be slanted because it's through like GM financing.
Dude, that's okay.
Credit.
Let's back up. Let's clarify. Regular bank financing, not through a special GMC financing or Ford Motor Credit or whatever.
Yeah. I would guess it'd be right around 3%.
About 3%. Michelle, what about in your world? Best rate on the auto, whether it's at your bank or the competition down the street.
Well, I know our bank, if it's brand new, it's 4.5.
Okay. What about what about competitors? Even credit unions, any of these
Credit unions wash us right out of the park. I can't even tell you what theirs are, but theirs are significantly lower than ours.
Okay.
But I don't know what those are, not being a lender myself.
Okay. The lowest I've seen in our market, in the Vegas market, and this is just across the board, in the last 2 months, 2.49. 2.49. But most are around 2.99, basically 3%, Kirk, like you said. Okay, what about the RV loan? Michelle, any idea your bank, what's the typical rate for an RV loan? And is it variable or is it fixed?
I don't know.
No problem.
I don't know, but I can find that one out too.
I would write that, either write it off to the side on a pad, or even while we're in the class, just text or email or text your lender. Kirk, what about in your world, RV loan?
I would say that they're at least around 6%.
Okay.
Maybe even like 6.5%. But again, those are longer term loans.
Yeah. So the lender is taking the risk, boy, they're locking it in for the entire 15 years, right?
And I don't know of any that are variable. Everyone that I'm aware of is fixed.
Fixed rate. Okay, now what about the home equity line of credit? Wow. Kirk, what is the best you've seen on this one? Either in your market or with your clients even?
It's very low. It's like 1.9% on HELOC, and they are variable. They're usually pegged to like something over, it's not prime. What's the other one that's called? It's usually like 0.5% more than something.
Wall Street, the prime rate?
Not prime.
Prime rate? Are you referring to LIBOR?
LIBOR.
Okay, LIBOR. Okay, good. The lowest I've seen in our market is prime plus a quarter. Prime is currently 3.25. That's anticipated to increase, but plus a quarter, meaning 0.25, or a total interest rate of 3.5%. Of course,
that's
the prime
HELOCs, you said?
Prime plus a quarter.
What did you say was the average for an RV loan?
Well, back on the RV loan, what did you say, Kirk? You said like 6.5?
6.5 is what I've been seeing.
Yeah.
I just want to write down because I don't know that part. So, okay.
Bad. Now the home equity line, like I said, in my market is prime plus a quarter. So prime is at 3.25 plus a quarter, or 0.25, for a total of 3.5. But for whatever's worth, my bank, where we bank, flexible in the front end. They've got a little teaser for 6 months, and it's like 0.99. I think you mentioned that, right, Kirk? 0.99%. Wow. But that's only for 6 months, and then it will adjust, if you will, on the HELOC or home equity line of credit. Okay. What is the collateral to complete this structure? And the consumer loan officer does this. they should do this, follow this format. Good, solid structuring of the loan. The collateral over to the right underneath the auto, of course, the title to the automobile. The RV, the title to the RV, as we said earlier, on the HELOC, the mortgage deed on the house, typically second position. Okay, let me ask a question I do not know, but this is a Michigan specific, state of Michigan question. In the state of Michigan, when you obtain an auto loan, does the title to the automobile go to the bank, and does the bank hold the title?
No, we just make sure that our name is on the title as lost payee, and off it goes.
Okay, wait. So you do not, Michelle, you do not physically hold the title in your file?
No, we have a copy of a title in our file, but we do not have the original in our file.
So how are you put on as far as collateral?
On the bottom of our titles, it has a place where you can list your lost payee. In the event that that is damaged, then we are in position to collect on that.
And you put your bank name, and
Yep.
then do you send that to the DMV?
Yes.
Okay.
And it's on the cars. We have this cars program now where we can actually go out and look up the auto by VIN number that says we are the lien holder on that car.
Okay, good. So evidently, Michigan is what's called a titleless state. Whereas, okay, Oklahoma, I physically go to Oklahoma, train there regularly, the bankers, the lenders, and they do the same. But in Nevada, California, and most states, the lender holds the physical title in their file, believe it or not.
That would be a lot more work, I would think.
Well, I don't know, that it's a throwback to the old days where the lender would say, hey, we want to physically hold the collateral, if you will. It's kind of that mentality. But interesting. So I didn't know that. Michigan, yours is they usually call that, a titleless state. There is a title, but you don't hold the title. Kind of interesting. In fact, in Oklahoma, I believe it may even be one step further, where there is no title. It's just the bank is recorded with the DMV as the lien holder, and it's just basically in their system, if you will.
Right now, we just rolled out not too long ago a cars program where they are going forward soon, not yet, but they're working towards, if there's a lien on a title, the customer doesn't even get it. It stays, they don't get a paper copy.
Interesting.
Yeah, and it's held.
Yeah.
Where they're just working out the bugs. They're just starting it right now. So right now we can go out and search for vehicles by VIN number and be able to see who the lien holder is to ensure that we are. But going forward, there will be no paper copies unless there is no lien on the title.
Interesting. Good. Interesting. If you were a title holding state, I'd put this in your notes just as a point of reference. Okay. Because, like, for example, Kirk, you work with regional banks in multiple states. So keep this in mind, that the big issue with the title to the vehicle, the automobile or the RV, when the lender does hold the title, sometimes the DMV makes a mistake and sends the title, mails the title to Bob and Sue, and there's no lien holder, and Bob and Sue will walk in your bank. Now, this is not in Michigan, but in other states, they'll walk in your bank and they'll say, aren't you supposed to hold this in your file? And you look at it and they hand you the title, and you look on the little line that says lien holder, and it's blank. Wow. And the lender starts to shake like, oh, right. Wow. The risk, and this does happen. And this is probably, Michelle, why Michigan and Oklahoma and probably more states are going to go to this, like you said, this system. The risk is, if they get the physical title, there's no lien holder because the DMV has made a mistake, and they don't bring it into your bank. they can go down to the street to another bank or a credit union or whoever, take that title and say, well, hey, I bought this car. It's free and clear. Would you give me a loan on it?
We
Seriously.
spend a lot of resources on the loan side, tracking, monitoring, and getting, we do a pending list. So if a
Yes.
customer comes in,
Yes.
if they're not buying the car where we're submitting the TR11 and we're getting it all through them, if
Yep.
they actually have the car in their hand, they have the title in their hand, they're supposed to take it to the Secretary of State. When they get our lien put on it, they're supposed to bring it into us.
Oh, okay.
So, but,
Interesting.
as you can well imagine, customers are not always as spot on as they need to be.
That's
So
true.
we end up chasing
Wow.
chasing them a little bit. That's where the CARS program is nice, because if they did get a chance to get in to the Secretary of State and they did put our title, our name on it, we can print it right off the system as proof that we have our lien.
Good.
So
Excellent.
that's kind of nice.
Good. Let's move forward. Thank you for those comments.
Yeah, by the way,
Go ahead.
I'm sure accidents happen all the time, but that's very rare. Like I've heard of one instance in my entire life where the lien wasn't put on the title and the car was sold.
Okay.
They still owed money on the car, even though they sold it free and clear.
Yeah.
But I think it's happened like one time I've ever heard of in my life. So
Okay.
they've got it pretty nailed down from a system standpoint. I
Yeah.
think.
You bet. Well, thank you for that. Let's go to page number 22. The next step in the process of consumer lending, consumer loan support. Now, the loan is not approved, but the underwriter, the lender will look at this and say, well, on the auto loan, to support the loan, we're going to have a promissory note. We're going to have a title with the bank named as lien holder and insurance. So supporting this loan, I would highlight A2, title to the vehicle. That's the biggest support, as we just had that conversation. RV loan, same, and I would highlight or circle title to the vehicle. Lastly, the home equity. What's the biggest support? Well, the promissory note, the insurance, but it's the second. TD stands for trust deed, MD, mortgage deed. In Michigan, you call it a mortgage deed. I'd highlight second MD on the house. So the lender does the first page on the previous page in the structure of the loan. Then included in this, they do the loan support and really further structuring the loan. Then if you'll turn with me to page 23, before they go into loan documentation, I'd put at the top of this page 5 C's of credit plus loan approval. The 5 C's of credit plus loan approval. So they've done the structure, they've done the support, they've done the 5 C's. We insert essentially the 5 C's in our underwriting in the process of the lending in this section, and we get loan approval. Okay, Michelle, I'm going to ask you, don't tell us names, but in your bank, pardon me, in your bank, Michelle, do you, the way the process works, do the individual loan officers, are they giving lending, what are called lending limits? 50,000, 100,000, 400,000, 500,000, meaning that they can approve that consumer loan, within their limits. Right. Is that how you do it?
Yes.
Good. Most banks do, but now when it comes to consumer, mortgage, commercial, they're given lending limits, but the commercial loans are oftentimes much larger. Yes. So the vast majority of the loans must go to loan committee.
Loan committee or board, depending on the dollar
Good.
amount.
Depending on the loan amount.
Mm-hmm.
Good. So, but no matter how you look at it, we now have loan approval. Mm-hmm. We've inserted the 5 C's in the process, and we've got loan approval. Now we go into loan documentation. Okay, Kirk, Michelle, I'm going to ask you a question, a rating question. On a scale of 1 to 10, 10 is the highest, 1 is the lowest, like we've done before. How would you rate your knowledge of loan documentation overall? Michelle, what would you say?
Consumer-based or the other side?
We'll just say consumer-based for right now.
Consumer-based, I am okay, but that's why I'm taking this class to learn more. So I give myself probably a 6 or a 7.
Okay. Kirk, how about you? Loan documentation.
I would rank myself a 1 or 2. The only experience I had with that was the loans that I applied for. So
Gotcha. Okay, now we're going to go in depth on many concepts related to specifically consumer loan documentation. Now, there's similarities between this mortgage and commercial loans, of course, documentation. But we're going to focus primarily, of course, on consumer. Before we do so, look at these general comments under A1 and 2. Off to the right of A1, I would circle bank policy and the word law. Bank policy and law. We have got to be in compliance with bank policy and law. Under number 2, I would highlight or circle the words no rework. Okay, now, do not look back on the first page. Do not look back on the first page of our PowerPoint presentation. I need each of you to write my last name right below no rework. How do you spell my last name? Don't look back. Don't look back. How do you spell it correctly? It's unusual. Okay. Okay, Kirk, how do you spell my last name?
I wrote Osmund.
Okay. Michelle, how do I spell my last name?
Osburn.
Correct. Now, okay, what letter have I had numerous lenders put at the end of that last name in real life? And I had one that argued with me that you have this letter at the end of the name. And I said, no, we don't. What letter would you say, Kirk? What letter do you think it is?
Probably the letter E.
You were right on, E. And I said, no, we don't have any. Ours is the Americanized modern version. Oh yeah, it's Osborne with an E. I said, no, it's not. He argued with me. Finally, I said, I'll tell you what, I'll take my wallet out, my driver's license, I'll show you. He looked at me and goes, oh, maybe this guy, he could see the body language was like, well, maybe he knows how to spell his name. We don't want to have to redo the documents. Not only is it embarrassing, pardon me, but from a marketing standpoint, it is not efficient. It's embarrassing. We just don't want to have to take that productivity time to do it. No rework of the docs, hopefully. It's going to happen periodically, but we keep it to a minimum. Turn forward to page number 24. Now, foundational for consumer loan documentation. And this does apply to mortgages and commercial loans as well. The promissory note is the main contract. The promissory note is the main contract between bank and borrower. Here are the steps of the contract. You can see under number 1, offer and acceptance. We offered Bob and Sue terms on the contract. Do they accept the terms right out of the chute? No. Sue says, oh, we can do better down the street. Bob says, oh, we can do better online. But once you come to terms with Bob and Sue as the lender, look under B1. Genuine mutual assent takes place. That's a legal phrase. It means the meeting of the minds. I would write that down, please. It means the meeting of the minds. You got a deal. Look at number 2. They have to have legal capacity to enter into this contract. Because if they don't have the capacity and you have them sign the contract and they default, guess what? You have no recourse to go after them or the automobile or the RV or whatever. Are they minors? No, Bob and Sue are in their 40s. Are they drunk or drugged? No. Insane? Hopefully not.
Question, if I can interrupt here.
Go ahead.
Because
Go ahead, Michelle.
We just had a discussion. Father comes in with his 16-year-old son. Father wants son to have the loan in his name.
Yep.
So, but father is the co-borrower or the borrower. He's on the loan with his son, who is 16 years old.
Yes.
All right. So legally, because dad is signing it, the legality we get falls right on top of dad. That's where it goes. Recently it came up as, do you pull a credit report for a minor? Is it legal to pull a credit report for a minor? Yeah. And we've had this discussion, and to me, a minor is not able to sign anything, or they're not legally obligated for anything. But you can look at it in two opposite ways. They're not legally an adult, so they can't even say, yes, it's okay for you to pull my credit report. But can dad say it's okay for us to run a credit report on the minor?
You're saying, can dad say that, right?
Yeah.
Whew.
I know this is a gray area.
That one is a gray area. My personal opinion, the way you structured the deal with the dad and the son being co-borrowers is correct.
Yep.
And obviously you can pull his credit and so forth, but on the son, I could see some bank attorneys saying, no, we don't want you to do it. It's too gray. We don't want to go there. Others saying, oh, it doesn't matter because really the son doesn't really have a contract.
Right.
He doesn't have a contract because of 2A.
Right.
So they may say, well,
question.
Yeah, they may say pull it anyway because it doesn't really matter, except if you attach it, meaning to his file, if you're inputting into the system, it's going to build his credit. I mean, is that the goal of having that the dad's trying to have the son join with them? Is that the goal?
No, a lot of the people around here want the kids to get established in learning how to pay their bills before they ever get out of the home.
Gotcha.
It's not anything like that. And of course, at 16-year-old, they're not able to sign a loan. So any parent that signs with a minor, they know that they're taking the brunt of
they're taking the full responsibility.
Right. But they want to teach their child to pay their. But
so I don't know. In that regard, I would almost say I would not have him sign, but I don't know if I would pull the credit. Plus at 16, how much is going to be there anyway?
Well, that's the thought, but one of the thought processes that came across my table was, what if there's identity theft fraud on this young person, and if we pull it and we find it, we're doing them a service by saying,
that's true. That's a good point.
We pulled this just to make sure everything was clear, and listen, you might want to reach out because there's a problem.
That's a good point.
So
Kirk, what's your thought on this? What's your thought on this idea?
As a consumer, I think it's a dumb idea, but I have no idea from a banking standpoint.
Okay. In other words, from a consumer, would you not sign with your 16-year-old son, or would you say, no, let's do the co-sign, but don't pull his credit?
I wouldn't even think to have like my son or daughter on a loan until they're 18.
Got it. So you would just say, no, let's wait till you're 18, then we'll do it. Okay.
Because they're kind of stupid when they're 16. Actually, they're still stupid when they're 18. They're probably stupid till they're about 25. Right?
About 25. In fact, I've read in the last few years studies that say the average human, their brain doesn't really, for lack of better words, solidify or kind of, stabilize, or whatever you want to use the phrase, till they're 25. But I mean, there's some 21-year-olds that are very mature, and there's some 21-year-olds that are not quite there. So, and not to be personal, but even within our own family, we've seen extended family night and day in that regard. Number 3, this is huge consideration. I would highlight or underline this Number three, this is a part of contract law that is oftentimes missed. There must be an exchange of value to make this contract legitimate, this promissory note. The exchange of value is we give Bob and Sue $35,000 to buy the automobile. They give us their signatures on our promissory note, security agreement, on and on and on. In exchange, they promise to pay your bank back principal, including interest, over so much time, so much interest rate, terms, conditions, and so forth. Exchange of value is huge. Now, I put off to the side of that to the right, 20% rule of thumb. Whoa, what's this? In a commercial lending perspective, if an individual owns 20% or more of the borrowing entity, the company, most banks in America today are going to require their personal guarantee.
Beneficial ownership. Beneficial ownership.
Well, no. Whoa. That okay. Just Michelle, very good point. This is a separate issue than beneficial ownership.
Okay.
Beneficial ownership is 25%, and that's just clarifying who's on first, from a compliance standpoint and so forth. That's a separate issue, really. This is percentage of ownership of the business from a consideration perspective legally. Does that make sense? Separate issue, completely separate. The exchange of value is it's quote unquote assumed that if they own 20% or more of the business, they have adequate consideration. There's exchange. Our loan to the business will benefit them personally. Therefore, we can legally require a personal guarantee.
Yeah,
does that make sense?
Yep.
So that's separate. Good point. A lot of times when I explain this, and it used to be before beneficial ownership, everyone just said, oh, okay. But now I hear this a lot. Oh, you mean beneficial ownership? No, that's a separate issue for disclosure purposes at 25% or more ownership. This is legally tied in to the loan.
Oh, because we do, on the commercial side, if we have a business 9 times out of 10, we pull in the owners of the business as guarantors.
And did you know if your commercial lenders at your bank, Michelle, use the 20% rule of thumb? Some banks will go up to 25%. Some banks will even be as low as 15%.
I don't know that there is a percentage on it. If they are an owner, if they are listed in the legal documentations as being an owner,
no.
They're usually brought in, unless we're talking about a corporation that's multiple owner.
You bet.
Then it would probably be the top management that would be pulled in.
I'd still write that in your notes and ask your underwriters, your lenders, hey, when it comes to taking the guarantee, not beneficial ownership, but guarantee, do we use 20 or 25%? Most banks use 20. Okay, Kurt, not to be personal, don't tell. If you can't say, don't just say I can't say. Have you ever guaranteed a commercial loan?
I did with my commercial building.
Okay. And you had at least 20% or more ownership in the building, right? Or in the LLC, correct?
I was 100% owner of the LLC.
Oh, so you're 100. Yeah. So they required the personal guarantee.
I actually bought it with a 504. So
504 loan, SBA 504 loan.
Yeah, I brought in 150 grand, and then the SBA financed
90%. So you put 10% in the 504 loan program. Between the bank and the SBA was 90%, correct?
Correct. The SBA was 40, the bank was 50.
Yeah. Sometimes the bank's 40, sometimes SBA is 50. Yours was there. In this case, the SBA was 50 or 40.
The SBA was 40.
40, and the bank was 50.
And Key Bank was 50.
Got it. So they're in first position, just from a structural standpoint, and the SBA debenture is in second position or second mortgage. Good.
Correct.
Must be legal. Okay, now this is tricky because some states, including Michigan, marijuana is legal. Is that a true statement, Kirk?
It is correct. Yeah.
Okay. Now, is it legal for medical and recreational or just medical?
Unfortunately, yes.
It's
Both.
both. It's both?
Just-
Okay. Now,
Up to a certain, up into a certain amount. Yeah,
okay. But federal law says it's illegal. And Michelle, your bank is FDIC insured. Is that true?
yep, that is in fact
So
true.
there's this big conflict
Uh-huh.
because for this promissory note, this contract to be legitimate, it's got to be legal. But we have a conflict in America within banking where you've got federal and you've got state law hitting each other within banking. I put in your notes right underneath number 4. Pardon me, the SAFE Act, S-A-F-E, S-A-F-E, like the safe or vault in your bank. It stands for Secure and Fair Enforcement Act. Secure and Fair Enforcement Act. It's floating in the US Congress right now. What if it goes through and becomes law? Pardon me, what will it do? Well, what I can tell you what it won't do is it will not make marijuana legal nationwide. No. But what it will do, or at least the intention, is to lower the friction or the barrier between federal and state law relative to marijuana, relative to banking, so that you can lend to the marijuana industry. And you say, well, what does this have to do with consumer lending? Well, Bob and Sue come to you and they apply for that $100,000 HELOC, home equity line. And on the loan app, and the purpose at the top, it's blank. Oh, and you're ready to fund the deal. Oh, okay. Hey, can you fill in what the purpose, whatever, repair the house, whatever, it doesn't really matter. And all of a sudden they fill it in and they hand it to you and you read it. Home equity line to be used to fund a retrofit of our basement into a grow house operation. What? Some banks would follow, that's fine. A lot of banks would have a lot of heartburn. Okay, Michelle, I need to ask you, don't tell us names. Does your bank bank the marijuana industry in any way, shape, or form?
Not marijuana, but hemp.
But hemp, but not marijuana itself, right?
Right.
And now, once again, if this goes through, it's going to lower the barrier between federal and state law and banking relative to marijuana industry. But it doesn't mean your bank will bank the marijuana industry. You have the legal right to say, oh, the board of directors of your bank says, oh, we've decided we're not going to do it. That's your choice. That's your right. Okay, this stays in our class amongst ourselves. Kirk, me, Michelle. Michelle, in your opinion, if this law goes through, the SAFE Act goes through, will your board of directors say, oh, we're not going to do marijuana. We're going to bank the marijuana industry? Or do you think they would still say, no way?
That's a great question, because some of our board members are actually egg farmers. I'm going to say they probably err on the side of conservative
Okay.
and probably say no, but
Okay.
I could be way off.
Okay. Only approximately 4% of all banks in America currently bank the marijuana industry. 4%. So not that much. It's because you can do it today, but the regulation is intense. And a lot of banks, in fact, we have a community bank in Las Vegas that got in it for about 18 months and got out. Nothing to do with the law or because it's marijuana. It's because they were losing money. The amount of employees and the productivity to get to this to legally do it was just horrendous. Number 5 must be in writing to make this a legitimate contract. Okay, Kirk, if you can't tell us, just say I can't tell you. But Kirk, do you enter into a formal contract with your clients?
Yes.
Okay. And you always have, is that true? From day
from the
one,
jet.
once you started working with these various regional banks, correct?
Well, I'm not 50 years old, so I bought the company.
Okay.
I can't hear you.
You're
I
on
can't
mute.
hear you.
Kirk,
there you
you're
go.
on
Now
mute.
you're-
There
I'm
we go.
muted, sorry.
Sorry.
Yeah, so when I bought the company, there was very loose agreements. I would say within the first year and a half, I tightened those all up.
Got
So,
it.
so yeah, but now like we must have agreements or we won't do any business.
Got it. And I agree with that personally.
Yeah.
Plus, correct me if I'm wrong, since you bought the company, Kirk, the complexion and the magnitude and the size and all of that has definitely changed to where it makes sense. It's under contract. Is that right?
Yeah, correct. Because back then it was print mail. So you
Yeah.
buy it or you don't.
Yeah.
Now it's all software as a service with all kinds of integrations. It's too much work without contracts.
Got it. I agree. Good. Let's move forward. Now, further in documentation. Documentation examples, fixed rate, closed end auto loan, RV loan. Well, the loan officer structured this before, but now they're actually doing the documents. Promissory notes, security agreement we talked about with the title, truth in lending disclosures, including the APR annual percentage rate, which doesn't apply on a commercial loan, but a consumer and or mortgage loan, absolutely. Insurance as well, all part of the documentation. Turn to page number 26.
I did get an answer on the RV loans. If you don't,
Go ahead.
I don't know if you
Go
want me
ahead,
to
Michelle.
answer.
Go ahead.
Because I told you I had to ask because I didn't know.
Yes.
We do only fixed rates on RV loans.
Okay.
And the rate depends on the year of the RV.
Okay. Interesting. So only fixed rates. Well, is the term 15-year amortization?
Yes.
Okay, good. Excellent.
Yep. So didn't know the answer to that one.
No problem. I love it. I love it that this is live to where not only we're all live, but you're able to get your responses. Because most people I say, oh, write this down. Then you have 5 or 10 or 15 questions. And then, the next day or a couple of days later, you sit down with your coworker or your boss or whoever, or your loan officers. And, just so you round out the concept. Boy, you're doing it live.
David, I think we're seeing a trend here that
Go ahead.
everybody in Michelle's bank is scared of her. And then they must respond immediately.
I love it. That's good.
I do have a little bit of a following, a little bit that way, but I don't think scared is the answer. They just know that I will nag them because of my job. I'm the loan documentation person. So the lender does the underwriting and they make the decision, they hand it over and they say, here, make it work. And I want to sign the papers on this day.
Right.
That's good.
Nothing
I
but
love
love,
it.
just teasing.
I love it.
But you're not off. You're not that far off.
Okay, now let's do this page and then we'll take our first break of the afternoon. Revolving line of credit, open-ended HELOC. Now this includes real estate issues. So the documentation, pardon me, is a little different than that term loan, auto loan, or RV loan. The promissory note you can see under 2A, I'd highlight with appropriate disclosures. What are the disclosures? Where you advance payback. Whereas the other type of promissory note are one directional pay down, P&I principal and interest. Mortgage deed, typically a second. What about rescission notice? It's a 3-day right of rescission. Why? Because Bob and Sue are touching their equity in their home. Most states say, oh, it's federal, but most states, even historically going back many decades, wow, they started to say, oh, we want to give Bob and Sue extra rights on a consumer loan that deals with their property, meaning their real property, their house, their home. In fact, in Texas, you could not even get a HELOC for actually 10, 15 years or more after the entire nation allowed it in the state of Texas, state law. Maybe it may have been even longer than 10 or 15 years. It's quite a while, as I recall. Okay, right of rescission off to the right of Part C. We're going to work a little scenario just to highlight this. Bob and Sue sign your documents on Wednesday. Your bank is open, at least part of your bank is open on Saturday. And Monday is a federal holiday. It's a 3-day right of rescission. They can back out. What is the first day they can get the money? They sign on Wednesday. Your bank's open at least partially on Saturday. Monday happens to be a federal holiday. What is the first day?
Saturday?
Okay, Michelle says Saturday. Kirk, what do you say?
I think the bank could give the money on Wednesday,
On the day, okay?
the date of signing.
The day of signing. The answer is Tuesday. What? 3-day right of rescission. You cannot fund, they cannot have access to the funds for 3 days. Let's count the days. They sign on Wednesday, Thursday, Friday, Saturday at midnight. Sunday, you're closed. Monday, you're closed. Tuesday is the first day they can get the money.
So it's at midnight is
Yes.
that's the thing that got me. It's Saturday
Yes.
at midnight is
Exactly.
actually the third day.
Exactly. Does that make sense, Kirk, what I just said with the timing?
Yes, sir.
Okay.
So
Title search. Go ahead.
whenever I bought cars or anything like that, they just waited. They didn't worry about it.
I agree. That's true. Well, in the old days, when this first came about, when I was a consumer lending years ago, when this first came about, the customers rebelled at the community bank I was at. And so we would have them sign where they were given the acknowledgement. And then they'd say, turn around, I turn around, and they'd sign the other. So they didn't have to come back to the bank. Now, was it technically correct? No. But it was new at the time. And they just says, oh, well, I think this is stupid. And I had several customers rebel and I didn't tell them what to do. They just said, hey, can you turn around? I'd turn around, they'd sign. And then I turned back and said, wow, you got here 3 days from now. Well, okay. And the way we went. If I was a consumer lender today, would I do it? No way.
What
That
are the
was
two
back in
documents?
Pardon me again?
What are the two documents that you're referring to, please? Or is it
The rescission notice. It's a notice that actually says where they say, oh, we acknowledge we got it. And then we acknowledge that the 3 days has expired. Now we haven't backed out of the deal. We're going to go forward on the deal.
So that's the intent to proceed one that you're talking about.
Exactly. But when I'm saying, Michelle, back in the old days, when this was brand new, customers after customer after customer rebelled and said, because it was brand new.
Mhm.
And they said, oh, I don't want to have to come back. I don't, whatever. I'm just going to sign it now.
Mhm.
And we'd allow them to do it. I would not. If I was a consumer lender today, I would not do it. Title search, appraisal, flood. It does flood in Michigan, doesn't it, Kirk?
Yes,
every
it
once in a
does.
while?
Yes, sir.
Flood determination, insurance on the binder certificate, and so forth. Now let's move forward. Now, let's go ahead and take a quick 5-minute break, and we'll come on back. We're going to close the loan monitor, and then we're going to go into the compliance collections. I think you'll find interesting. Talk to you in 5 minutes, everyone.
I don't
Thank
think
you.
anybody's ever found that interesting, by the way.
Good. Is good. Welcome back, everyone. Let's go ahead and continue forward. Closing the loan. This is basically sitting down with Bob and Sue, signing them up. Under Part A over to the right, I would highlight or circle the word educator. When we close on the loans, we have got to be like an educator. Sometimes, and I've seen this, Michelle, I don't know if you've ever seen this working with your lenders, but sometimes I've seen lenders almost, if you will, pawn off the closing to an administrative assistant and say, well, I'm busy. I've even seen lenders do this when they're sitting in their office working, and they'll get the administrative assistant to sign up Bob and Sue in a conference room. And it's like, I can't be bothered with that. That's petty. But the truth of the matter is, this is a crucial time to interact with the borrower. Would you agree with me, Michelle? Or you're on mute. You're on mute. Well,
Yes, I agree.
okay, good. And it happens. It happens. Now, in the close, under Part B, I would circle or highlight positive image. I would also, under Part C, circle or highlight cross-sell. One of the major mistakes by the lender not being involved in the close is they can't further sell the bank. They don't allow the bank to shine. I'm not saying the administrative assistant can't close the loan, have them sign here or there, but oftentimes when they have questions and Bob and Sue said, well, can you explain this or that document, or now what is this? They're not the lender. They're not trained. They're an administrative assistant. They obviously fulfill a very important need within the department, but they're not the loan officer. Moving right along.
They also missed the opportunity to ask for referrals.
Ooh, that's good. That's good, Kirk. They missed the opportunity to get referrals, which is part of that cross-sell. That is good. Not just cross-sell with more products and services to Bob and Sue, but Bob and Sue's neighbors, friends, associates, family members. That is good. That's a very good point. Good, moving right along. Referrals is huge. And once again, in your business, Kirk, you work nowadays. Is this true? Most of your marketing is done by referral. Is that true?
Ours is either found on the website or referrals.
Or referrals. Either they find you on the website or they're referrals. And I don't mean to speak out of school, but that's how my business is. My practice, my training practice is now they find me on the website, or in fact, more often than not, it's a referral. Good. And I would dare say, Michelle, in your community bank is probably pretty similar. Is that true?
It is very similar, yes.
Yes. Moving right along. Monitor the loan. We monitor the consumer loan. What items do we follow for in our tickler system under Part A that we track? I put in your notes, Part A, insurance, updated financial statements, updated tax returns, you name it. If it's a home equity loan, and maybe even the tax, are they current on their taxes on the house, and so forth. Look at Part B. If you'll circle automation and human, automation is what? Most tickler systems are automated. Michelle, at your bank, is your tickler system, is it automated? Or is it more manual? Some community banks, small community banks, are still manually done. They're sending out the notices.
It's a different word that you use, but we have a pending list. Is that what you're referring to?
Well, okay, but let me, for example, if you need an updated tax return for the file,
yeah,
do you manually send that out, or do you have an automatic or automated system where you input into your software and it automatically sends out a little notice? Yours is manual, correct?
Yep. Ours are Dear John's. Dear John.
No, Dear John, because you're in a smaller community bank.
Yeah.
Most larger community banks and then regional banks and big banks, it's all automated. Now, Kirk, in your business, you don't deal with that aspect of the process of lending, do you? Where you Does your software work with the tickler system at all or not?
That's ultimately what we do, right? It's all automated. Yeah.
So it is. Okay, good. Moving
Yeah,
right along.
Not only that, insurance, whatever, but also like it's the anniversary of your loan or,
Yeah.
all that stuff. It's all automated. Yeah.
All of that's automated. Good.
It has to be.
It's got to be. Yeah. Well, especially the regional banks with the volume they're doing, correct?
Right.
Versus Michelle, your small community bank, obviously there's a difference.
Yeah, there's a difference.
Oh, yeah. Now we go to our compliance. We've completed the A to Z of the consumer lending process. Section number 10, compliance. And at the back of this, it's just a quick review. This is not an entire compliance class, of course. Encourage you to do that. Most of your banks and most of your organizations, you have to do that on an annual basis and so forth. Even as a college professor, I get the Dear John email, and not the in the mail, but Michelle, I get the Dear John email from the college, and it says, oh, you're past due on such a training compliance, and I have to go in and do the tutorials and all that. Mm-hmm. This is just intended to help us just focus on compliance and then the back end of the loan process, collections. So just a little snippet on compliance. Reg B, I mentioned this earlier. Equal Credit Opportunity Act. Prohibited basis, if you'd write this down. We cannot lend or any aspect of lending within the bank, whether it's consumer, mortgage, and or commercial, based off prohibited basis. What's one of them? Race. Here's another one. Race, creed, color. Race, creed, color, gender, marital status, age, race, creed, color, marital status, age, sexual orientation, and on and on. There are many others. Okay, we're going to do a quick little activity here.
Hold on.
Go ahead.
What does creed mean?
Creed, good question. Creed is the word means a belief system. Belief system is a broader concept. Sometimes you will see this regulation instead of creed, Kirk, it's religion. But the broader concept and the actual, from what I have seen, it's actually creed. Creed means belief system. Religion, a particular religion, is underneath creed. For example, Kirk, you are a Roman Catholic. You are Jewish. You are whatever, Muslim, whatever. That's a religion which is underneath the overarching or broader concept of creed. But your belief system, Kirk, may not be an actual defined religion. It could be some other belief system. So creed is a broader concept. Religion is part of creed. Creed is not necessarily religion. Does that make sense?
Yes, sir.
Okay, good. Okay, now for marital status. Can either of you tell the class, our group, what are the only 3 legitimate marital status in America today? There's only 3. Michelle, can you do it? Try it. Michelle, try it if you would. What's one of them? What's one?
Single, married, or divorced?
Okay, let's go with single, married, divorce. Single, prejudicial, strike it. Married, yes. Divorced, prejudicial, strike it.
Okay.
Married, you got one of the 3. Kurt, can you think of the other 2?
Widowed?
Widowed, prejudicial, strike it.
Dang,
I
what
love
is it?
I love it.
How about not married?
We'll give it to you. We'll give it to you, Kirk. Unmarried,
Unmarried.
married, unmarried, separated. Married, unmarried, separated. Now I'm going to say it straight out in the tax code and on the tax forms. It's married filing jointly, it's married filing single, or single filer. It's not even up to speed with the correct in America, but don't tell the IRS that. That's the tax form. Seriously. When you say single filer, that's prejudicial. It should be unmarried filer. Married, unmarried, separated. Moving right along. Further in our compliance, Reg Z, we talked about already. These are the black boxes at the top of the contract. You don't have these on a commercial loan because you don't have to disclose APR, annual percentage rate, the true cost of the loan, which is the simple interest rate plus the impact of a loan fee or doc fee. Finance charges payments, but in a consumer loan, you do. Mortgage loan as well. TRID down below for the mortgage lenders. Okay, Kirk, does your system support the TRID disclosures?
Yes.
Oh, you're making my day. My personal opinion, and I tell all the bankers that I train, when it comes to TRID disclosures, which is a combination of truth in lending and respite, you can see it's kind of a combo. I tell them my personal opinion, I would use software to track those dates because otherwise it can get a little sticky. Would you agree, Kirk?
Yeah, anytime you put a human in the middle of something happening, you're gonna miss a deadline.
Yep. Yeah, very good point. Turn forward. BSA, Bank Secrecy Act. Michelle, have you ever worked with this in your career?
Every single day.
Every single day.
It's like a mantra. It's like
Currency,
tattooed on my forehead.
Okay, before you explain what it is, I have this vision of Michelle as like a secret agent right now.
That's a what?
Secret agent.
Secret agent. I love it. That's great.
That's the way we feel too, to be honest.
That's
with
true.
you.
Now, cash transactions, what's the dollar amount, Michelle?
10,001 penny.
Oh, you are a compliance specialist. I love it. 10,001 penny or more.
Right.
Good. Currency transaction report, or if you suspicious activities report, could this apply to a consumer loan? Yes.
Yes.
Monday afternoon, this coming week, Bob and Sue walk in your office and Sue says, how much do we owe on that auto loan? You turn around, you pull it up, 11,000. She goes, you will not believe it. I've got $11,000 in cash right here. In my satchel, she hands you 11,000 in cash. It will trigger a CTR. Is that true, compliance officer Michelle?
I'm not a compliance officer, but I do believe anytime cash is involved,
Yes.
that is going to result in
That's
a
it.
CTR.
That's it. Okay, let me ask you, Kirk, in your software, does it tie into BSA or not?
Oh.
Okay, none. Fair Credit Reporting Act, we've alluded to with the credit report. This number 6 is kind of a catch-all. Federal and consumer protection laws. And then if you'll turn with me now to page 32, pardon me, page 32, we're now going to go into collections. Now, as part of compliance, and this is really the back end of the entire consumer lending process. I mean, technically we say monitoring, but the reality is even in a strong economy, there will be people that die, get divorced, they get, the COVID, whatever happens. Why the past dues? Unexpected problems, economic downturns, the Great Recession, poor money management. We talked about consolidation loans earlier. Marital problems, substance abuse. I had 2 gentlemen that were owners of a small pool contracting company here in Vegas. Okay, they did residential pools. In Vegas, you can only have a pool no more than 5 feet deep because of the water, the lack of water. Okay. And these guys, these two partners, they went out and they did not do the high-end homes that you see on TV, you know, where it used to be 100,000 in the backyard. And, oh, now it's $500,000 or more, $1 million in the backyard, literally. And the elaborate back, not just the pool, but everything. Well, these guys just did tract home, what are called play pools. And they had this business model, and they made just money hand over fist, All of a sudden, and I was their commercial lender. All of a sudden, the one partner calls me. He goes, I got to come see you. Oh, okay. Came down to the bank the next morning, walks in my office and just blurts out, I just want you to know that my partner has a cocaine problem. I said, so-and-so? I was like shocked. He goes, yeah. I said, what? 2 weeks later, the partner calls me. He goes, I'm coming right now. It wasn't like, I'll see you tomorrow morning. He walks in my office and I knew what he was going to say. The partner has left town with most of the money of the business with him. Well, we can't find him. He goes, even his wife can't find him. What? Yeah, his spouse can't find him. Yeah, disappeared. Whew. Downturn. That loan was classified workout. Moving right along. Now, what's the first thing we do? We try to get those payments. We may even modify the note under number 2. Number 3, we may even refinance the mortgage and try to tuck the home equity loan or line underneath the mortgage and stretch it out to keep the payments low. Quite frankly, to hide the problem, not legitimately to hide the problem loan. Okay, now I need to ask a question on a scale of 1 to 10. 10 is the highest, 1 is the lowest, like we've been doing throughout today's session. How much experience do you have? How much experience do you have in collecting cash anywhere in your career, whether it's your current position, your current company, Kirk, or whatever? How much experience do you have in actually collecting the cash? 10 is the highest, 1 is the lowest. Because we're going to look at the law on the next page. Don't turn there yet. Okay, Kirk, what number do you give yourself?
I'm going to give myself a 6 because for 5 years, from the time I was 11 to 16, I only dealt with collecting cash.
Was it in a paper route?
Paper out.
That's it.
Lawn care, snow
Good.
removal,
All of
gutter
that.
cleaning.
Good. Michelle, what about you? Have you ever had experience collecting cash?
Very little. What I've done is for the organizations when we're doing fundraisers and we're selling tickets and so forth.
Okay.
That's about where my collections piece came in.
Okay, good. Good, thank you. Now turn to page number 34. This is the main law that governs collections in the bank. And quite frankly, with all lenders, all creditors. It's not just the bank, it's the federal, it's the Congressional Act, the Fair Debt Collection Practices Act. I would highlight that, please. Now, technically, this law only applies, you can see consumer credit law. It only applies when you have a consumer credit law and your bank, pardon me, consumer loan, not credit law, consumer loan. And number 1, number 2, your bank has hired a third-party collection agency. So if you do a direct collection on a consumer loan, this law technically doesn't apply. A mortgage loan doesn't apply. Commercial loan doesn't apply. You have to have a consumer loan and a third-party collection agency in the mix where your bank has hired it, or Kirk, your company is hired. Having said that, please do not violate any part of this law because they'll come back to bite you. Look at postcards. Lenders used to send out big past due postcards, cannot do it. It's a form of intimidation. Look at number 2. You call Bob and Sue. Sue says, oh, we forgot to tell you. We're represented by Jones and Jones, the law firm in town. You cannot go around Jones and Jones and go after Bob and Sue. No, you have to get your attorney to interact with their attorney. Look at the time frame. Time. Wow. 8:30 in the morning, Michelle. And you call that deadbeat. And he's got an operation in your town in Pigeon, and he's got an operation in Wausau, Wisconsin. You call, and he's got 2 operations. And you know this borrower is over in his operation in Wausau, Wisconsin. It's 8:30 in the morning in Michigan. What time is it in Wisconsin?
7:30.
You violated the law. Look at this. It's based, I put in your notes, subject to their time zone, the borrower. Place of employment only with permission. Number 5. Wow, number 5. It applies to consumer, but listen to this one, number 5. A week from today, you're at a chamber function, Chamber of Commerce, a mixer from 4 to 5. You're having a drink. Another lender walks up to you and she says, hey, are you guys chasing Bob and Sue? We've got a loan with them. We know you've got 2 loans with them. And what are you guys doing? We're chasing them. We're doing this. What are you guys doing? And Michelle, you say, oh, that's work. Hey, we're here for a party. Let's go have another drink. That other lender, she has violated number 5. Does that make sense?
Yeah.
Wow.
Confidentiality rule number 1.
Oh, yes. My personal opinion, this is my opinion only. I would not share anything of collections with anyone outside of your department, Michelle, at the bank. Why? Because, ooh, boy, everybody knows everybody and things could be said. And, well, Michelle told me this. No, only just the few people in your department, my opinion. Number 6, they refuse to pay. We have to cease to communicate. We call it Bob and Sue.
Is that law? If they refuse to pay, we cannot communicate with them.
Yes, because what happens is you call Bob and Sue. Bob picks up and says, will you please, and this is the law, this is the congressional act. Would you please back off? We're stop calling. No problem, Bob. But we want you to know, Bob and Sue, that we will exercise all of our rights to collect on this debt.
Okay.
But I would put this in your notes. Don't use the word legal rights, because when you use the word legal, that's a form of intimidation. Would you agree, Kirk? That's a form of intimidation.
It sounds more intimidating when you say that.
Yeah. Well, you just say rights. It's just general rights, whatever. No harassment. If you put an A and a B down below number 7, please. An A and a B down below. A, no profanity. B, no threat of bodily harm. No profanity and no threat of bodily harm. Let's turn forward.
Real quick, can you say again what it's okay to tell Bob? If I call Bob and Bob says, listen, you need to back off.
Just say, if he says back off, do not communicate. We're tired of the phone calls, the texts, the emails. No problem, Bob. We will cease to communicate, but we will use all of our rights, not legal rights, rights to collect the debt.
Okay, thank you.
You're welcome. Okay, Michelle, Kirk, that leads us right into hardcore collections, page 35. Whoa, serious delinquency, serious collections. Look at number 1. Consumer loan, wage garnishment. Commercial loan, this doesn't apply to, pretty much. Commercial, oh yeah. I mean, consumer, yes. 25 to 33% I would put of their gross pay, not net. Wow, that's tough. Right of offset, even if it's a joint account, I would put under number 2. This means pop the money out of their checking account. Michelle, in 20 years, how many times have you done that? Roughly 50, 20?
I've not ever had to do that, but I've heard of us having to do that because of an issue.
Okay.
I don't know what the answer is, though. I
Okay.
don't have a number.
No problem. Right of
But
offset.
I do know that we have the right to offset
Oh,
to
yeah.
any other account we have.
Oh yeah. If the money's in the bank account, it's gone.
Right.
The slang term is you pop the money. What about repo the car? Consumer loan,
Oh,
pop the car. What about a judgment? What is a judgment? This is where your attorney goes in and gets a judgment. Kurt, this could apply to your business. One of those regional banks, they quote unquote stiff you. They don't make the payment for a sizable amount of money. Of course, you're going to turn off their system, right, Kirk?
Yeah, we turn off the system and then we turn them over to a collections company.
Yeah. But a judgment, what is it? I put in your notes, it's a formal acknowledgement by the court that the debt is owed. A formal acknowledgement by the court that the debt is owed. Foreclosure, how many days? In most jurisdictions, 90 to 120 days. Pardon me, 90 to 120 days to foreclose on the house. Now, a commercial building, my personal experience, both sides of the table, as a lender, as a CFO, I would allow even upwards of 6 months on a commercial building, depending on the circumstance. Commercial building can have a lot more twist to it than just a single family residence.
It's funny that you say that. I mean, I understand, but there's actually less protection for commercial buildings.
I agree. Oh, I agree 100%. Oh, we saw that. Oh, Kirk, you're spooking me. In the Great Recession, we saw that. Is that true, Kirk?
Yes.
We saw that because a lot, in fact, during the Great Recession, a lot of states hurrying quickly changed their laws to where it protected the homeowner that was being foreclosed on.
Well, that's what I was just going to say. You'd
Yes.
think you would allow more time for someone if that's their primary residence and
Yes.
if they are legally struggling to pay their bills, you would think you'd
Yeah.
almost give them more
Yeah. Now,
time.
let me clarify. When I say the 90 to 120 days, that's what most traditional courts would say. The Great Recession, 08, 09, oh no, it depends on the state. For example, New Mexico, I had a client in New Mexico or a CFO client that dealt in New Mexico, and all of a sudden overnight, the legal system, the legislature in New Mexico allowed the homeowners to stay in the home like 6 months, 9 months, whatever, a year. That's a different story.
Okay.
Traditionally, it's 90 to 120 days. When I say 6 months, I'm looking at it from the bank's perspective of allowing for 6 months, because if you have multiple tenants in the building and a lot of other items, there may be a lot more to the complexion, a lot more complex than just foreclosing on a house.
Okay.
Does that
All
make
right.
sense?
Yes.
Okay. Two related concepts. We move into our case studies, but right after we do these, we'll take a 3-minute stretch break. Our last stretch break, we'll just do 3 minutes if that's okay with you. And we'll come on back and do our case studies and conclude the session. Short sale. 2009, pardon me, 2007, Bob and Sue buy a home in Lansing. $300,000. Okay. Let's say they put $50,000 down. Whoa, that's a good down payment. $300,000, they put 50 down, they get a loan from your bank for $250,000. Well, the house is worth $300,000. They bought it for $300,000. 18 months to 2 years later at the most, the height of the Great Recession in 09. And Bob and Sue have both lost their jobs. Even the state job, they laid off. Well, a lot of states had to start laying off people. They can't make the payment. So they go into default. All of a sudden, someone knocks on their door one night and says, hey, because they have a sign, for sale, whatever, right there. Hey, I'll buy your home for the fair market price of 200,000. It was 300. They put 50,000 down, 250 loan. Bob and Sue approach you at the bank. Will you approve this short sale? Some banks at the start of the Great Recession, no way. Other banks eventually, oh yeah, we'll do it, because they realize they're better off. But your bank would have to approve the short sale, which means you write off 50,000 of the loan. Bob and Sue's 50,000 down payment is gone. Because remember, it was 300. They put 50 down, 250 loan. The loan is written down or written off 50,000 down to 200. But by the time the Great Recession got into 09, a lot of banks, mortgage companies realized, whoa, we are better off doing this than to have to foreclose, take all the time, cost, management of the property, and so forth. Okay, Kirk, in your professional life during 08, 09, did you deal with any short sales at all?
None.
Okay. Michelle, how about you? Any short sales?
I didn't on a business level, but on a personal level, some of my dear friends bought just before that and went under really quick and had to short sale it.
Got it. So you've seen this live.
Yeah, it was
Good.
very disheartening to watch that happen, but yeah,
Oh,
that's
yeah.
exactly what happened.
Yeah. We have friends, neighbors, the same way, and extended family members. Whoa.
And
What
it was
about
better
it?
for them to get out of it themselves.
Oh, yeah. And actually, in the end, it was a win-win. Well, it was a win-win in a bad situation for the bank and the borrower, because there was no foreclosure. It was just simple, and boom, they walk and away they go.
Yep.
What about a deed in lieu? And if you will please add in deed in lieu of foreclosure. Deed in lieu of foreclosure. What is that? 2009, the Great Recession. Bob and Sue walk into your bank. They hand you these keys. Well, what's that? Well, that's to our house. We both lost our jobs. We're moving. We're moving this weekend. We've researched this. We've heard there's a piece of paper we can sign, and you the bank, it's your house. There is no foreclosure. Some banks approved these in 09, some banks did not. The banks that approved it, deed in lieu, they gave them the house instead of the foreclosure. The bank went out to it wasn't their collateral anymore, they owned it. The next day, we own this house because they signed off, we signed off, no foreclosure, they're done, they walk, we get the house. We go out to the house, we take the key, we open the door, we walk in, and it is immaculate. They've done repair work. The yard is kept up out on the front and backyard. Inside, they even had the carpet cleaned. We sell the house. Let's do the other version. Oh, no, we don't do deed and lieu here. We don't do deed and lieu here. No deed and lieu here at this bank. Sorry. Okay. Sue just takes the keys back. No problem. Bob and Sue walk out of your office. 90 to 120 days later, or back in that era, maybe 6 months, 9 months, a year later, I even heard of some situations up to 2 years back in that era. All of a sudden, let's say it's just 90 to 120 days even, the foreclosure takes place. You go out to your house. Oh, wait, it's done. We own the house. You drive up to the front yard there, front. The yard is wasted. You go up to the front door, and then this is when your anxiety level goes through the ceiling. The front door, Kirk, is blowing in the wind. It's flapping in the breeze. You're like, huh? So you slowly open the front door, and the stench knocks you over practically. You walk through the house. Somebody has taken a sledgehammer to every room in the house. Any bit of copper has been ripped out. Anything of value is gone. It is wasted. You think to yourself, wait a minute, this is going to cost $75,000 just to repair this house to get it ready to sell. Wow, maybe we should have done the deed in lieu. Michelle, any questions on that one?
No, I actually saw the results of not doing the deed in lieu on a couple of properties, and it's very ugly. But I don't know if I've never heard any commentary in regards to that. So I'm unsure. I've got a note to ask to see if we allow that.
Yeah, because some banks during the Great Recession, oh no, we don't do that. Other banks, they caught on and says, maybe we're better off, and they were. Kirk, any comments, questions on these last two?
No, I heard a couple people turn their keys in, but it wasn't anybody that I knew really.
Okay, let's move forward. Now, let's go ahead and take a 3-minute stretch break, and we'll come on back. We'll do our case studies, that little section, and then we're going to do a concluding activity. So let's go ahead, take just a 3-minute break if you would, and we'll come on back and get started. You bet. Thank you. Okay, we'll get started in just a moment.
And we do the deed in lieu, but we haven't done them often, thank goodness, but we do.
Oh,
often.
okay, so you have done them. Okay, as a follow-up. Well, Michelle, I love it. Once again, you're getting feedback on, like I said, most people, I just have them write these off to the right, on a little pad paper, and and they end up having like 10 or 15 questions at the end of the session, but you're getting them real time. Okay, welcome back. Now we're going to do our 6 case studies. We'll do these individually, meaning I'm going to have you read these, and at the bottom of the page, put a Y or an N, and then we'll talk about it as a team, and then go to the next one all the way down. Okay, the why, yes, you would do the deal. Remember, as I mentioned at the start of the session, these are intended to summarize all of the concepts in today's class. The first 3 are new loan request. The second 3, the last 3, are all workout problem loans. Okay, and each one of these, I'm going to have you highlight or circle the bullet point that is the loan request. So in this first one, the auto loan, if you will circle or highlight new $45,000 auto loan. And then if you'll read the parameters down below, debt to income ratio, the FICO score, so forth, yes or no, take just a moment on this. Yes or no, would you do this deal? Would you do this deal?
Just based on the information we have.
Oh yeah. Let me clarify. You cannot change the parameters, because some of these are going to, Kirk, very good point. Some of these we're going to be splitting hairs, real gray area, but you cannot change the parameters. It is what it is. So look at this one. Look at the parameters. Would you do this deal? Yes or no? Okay, Michelle, would you do this deal?
I'm on the fence. Hold on a second. Am I looking at from my bank parameters or just from what you?
No, your bank parameters and from our class today. We've got the debt to income ratio. We got the FICO score. Remember, we said the average FICO score is 700, 710.
Right.
We know the average bank's DTI max is 43.
Right. That's what's throwing me, is the DTI is too high.
Well, and the FICO scores are really low.
And too low. So my instincts are no.
You say no. Kirk, what do you say on this deal?
First one, no.
You're correct, both of you. But I would do this. Look at the 4th note. Look at number 4. I would let your bank president know, because the worst case scenario, she goes out to take her trash out and the neighbor's going to give her an earful. Is that true?
Oh yeah, that'll happen.
You want her to be forewarned.
Mm-hmm.
Okay, good. Scenario number 2, RV loan. Let me have you highlight or circle new $125,000 RV loan.
That's a pricey RV.
Well,
wow.
look at the DTI. It's a little higher end. It's not one of those class A, right, Kirk? 300, 400, 500,000, but it's getting up there. Look at the DTI. Look at the loan to value. Look at the FICO score. Yes or no. Put a Y or an N. Commit. Look at the parameters and make the decision. Y or N. Would you do the deal? No change in the parameters. Would you do the deal? Kirk, would you do this deal?
Yes.
Would you do this deal, Michelle?
Absolutely.
Yes, I agree. But what would you push to change? Loan to value. Get that down to 85 or even 80% preferably. Okay, Kirk, could you use the 73 years of age as a criteria to make this loan? Yes or no?
No, because that'd be discrimination.
Based off of what?
Age.
Right on. Reg B, Equal Credit Opportunity Act.
So David, you would actually, in order to bring that back down, that LTV, you would just request maybe a down payment for the difference to move it down to an
Yes,
80%?
yes, because they put 5% down.
Mhm.
And I would even do it. I would even do it at 95%. What I'm saying is, and I'm adding to the case study. So
Mhm.
we've already made the decision, yes, but what would I push for? More money down, another
Okay.
5, preferably get it down to about 85% or lower loan to
Gotcha.
value.
Okay.
Third brand new request. If you will highlight or circle number 1, $100,000 HELOC, second mortgage position. Read the parameters and put a Y or an N at the bottom of the page. And you cannot change these parameters. Would you do this deal? Y or N? Yes or no? Kirk, would you do this deal?
I said no.
You say no. Michelle, would you do this deal?
I said yes.
I love it.
Sorry, Kurt.
Okay. Kirk says no. Michelle says yes. My personal biased opinion, I would do this deal. But now, I remember you can't add to the model, can't add to the scenario. But if you could, I would say we do this deal, but there's got to be a clear explanation why this FICO score is so low. Could be they went through a divorce several years ago, and they can show us how they've improved their credit ever since, or something reasonable. But boy, besides that, look at the stability, 22 years in the home, 25 years on the job. Look at the low loan to value, including the first and the second on the home. Wow. DTI is a little high, not much. Okay. Now, the first of our problem loans. Now the challenge. I would highlight bullet point number 2, please. Circle or highlight. They're requesting 12 months additional. Stretch out those payments. The original was a 48-month or 4-year. They're asking you to extend the loan by 12 months, which will lower the payments. But go ahead and read the whole scenario. At the bottom of the page, put Y or N. Now, keep in mind, this is an existing loan. You can't say, well, I'm going to decline the loan request. Oh, no. This is an existing loan. But that doesn't mean you have to do or accommodate the request.
But it doesn't specify it's the existing loan at our bank or another bank.
Oh, no, it's our bank. Oh,
it is our bank. Okay.
Yeah, our bank. Yes. Oh, yeah, we're not refinancing. No, it's our bank. All 3 of these problem loans we've already made, and we're managing them. Would you give them another 12 months? Yes or no? Bullet point number 2 is the actual request. Michelle, yes or no on this one?
I would say yes.
Kirk, yes or no on this one?
I would say yes too.
I agree with both of you. I agree. I will say one thing. Now, remember, we can't add to it, but if we could add to the scenario, part of the requirement would be no 30-day lates going forward. Some of that is just mismanagement or sloppiness, is to use a slang term. Is that true, Michelle?
Yes.
You bet.
Because what I looked at is the LTV actually, the loan to value actually improved.
Exactly.
So we had some improvement.
Yeah.
Yeah.
So there's not all negative. There's
Right.
some positives, there's some negatives. Good. Our second workout problem loan. It's an RV loan. The request is under bullet point 1, the last sentence in bullet point 1, if you will highlight or circle. Borrower has requested help by the bank. The loan is with your bank. The bottom line question is yes or no. Will you help this borrower? Read the scenario and put a Y. Please put a Y or an N at the bottom of the page. Would you do this deal? Would you do this deal? Kirk, would you do this deal?
Yes.
Michelle, would you do this deal?
Yes.
Great. I agree. Most lenders would. We could even, as a bank, refer them. We may even bank 2 or 3 local RV dealers. We don't give them an endorsement, but we give them 2 or 3 names and say these are simple referrals. We don't legally want to be in the world of endorsing. Like, you got to go to this guy, because your worst nightmare would be the widow. In this case, we can say widow, not like, the marital status or whatever we're making the loan. But I mean, come on, she's a widow. We would say, we don't want to say you've got to go to this guy, and this particular sales guy, whatever, rips her off or does something goes high, haywire, if you will. There was a comment.
Yeah, just a quick question. In this case, is it legit, or is it something that you can do? Can you offer to extend the loan?
Oh yeah.
Until
Yes.
she can make those, she's dealing with the death of her husband. She's trying to do all this. Can you like we call it kicking the can down the road for a little bit, letting her get
I would put that in your notes. When you say yes, we'll help her. It could even be a combination. We'll kick the can down the road, and we'll refer her to 2 local RV dealers that we bank, that we trust. And we don't say an endorsement. We just say, here's a referral, 2 names, here's 2 business cards, away they go. We encourage you, because she's already told us, hey, she just wants out of this deal.
Right.
So we kick the can down the road.
World.
Yeah, temporarily, but then the big picture is sell the RV and the problem goes away. Mm-hmm. Our last scenario, a HELOC. The request is under bullet point number 2. Highlighter circle number 2, if you would, please. Highlighter circle number 2. Go ahead and read the scenario. Put a Y or an N at the bottom of the page once you're done. Would you work with them to consolidate? Kirk, would you work with them? Yes or no?
Yes.
Michelle, would you work with them?
Yes.
I agree. But would you both agree that it's a timing issue? Because you want to know, well, which of the 2 spouses is staying in the home, which is leaving, and do they have strong enough DTI, strong enough capacity or cash flow to service the debt? By consolidating, generally, as I alluded to earlier, boy, we take that HELOC or home equity loan and shove it underneath or with the mortgage and stretch it out. We lower the payments. We really dodge a big bullet.
We do, but we would have to have both parties in a divorce situation, which would be rare, to agree to sign the line, because I would assume both parties in that divorce would have to sign on the new one. So
exactly.
The odds of getting both parties to agree that this
and
is
that
the
may
best
be
thing
it.
to do.
You may say, we'll work with you if you in so many words, without telling them delving into their personal lives. As long as you guys can work together and work with us, we'll work with you.
Right.
But as you're alluding to, Michelle, a lot of times in that divorce, it's so intense and negative and all those issues that it doesn't work. And then
you would almost have to wait for the judgment of divorce, but before you could even proceed with anything.
I agree. That doesn't mean you can't structure it ahead of time and have a game plan in place, especially because it's already running past due.
Right.
Good. Very good comments. Okay, now shifting just to one little extra page we're going to cover, and then we're going to conclude the session. Loan pricing models. Most banks, for all of the consumer loans, like all the auto loans, all the RV loans, all the HELOCs, all the boat loans or whatever, they'll do a standard pricing on your price sheet, Michelle, right? Like you have.
Mhm.
There's also a standard rating, loan rating. Most banks have a 1 to 8, 1 to 9, or 1 to 10 rating system. Okay. And what does that mean?
Yeah.
You rate the loans. If it's a commercial loan, like a $3 million or $5 million commercial real estate loan, the loan is individually rated because it's a large dollar amount. But in a consumer loan lending perspective or scenario, you will rate them basically based off, these are auto loans. These are all rated on a scale of 1 to 8 or 1 to 9. These are all 3 or 4s, or these are all, 5s or whatever. But in a commercial loan scenario, they're individually rated. Questions on that, Kirk? Any questions on that?
I have no idea what you mean when you say commercial loans are individually rated.
Okay.
Yeah.
In a bank, in a commercial loan, the individual line of credit, the individual equipment loan, the individual commercial real estate loan, $500,000 line of credit, $750,000 equipment loan, $3 million commercial real estate loan on the building. The bank, the commercial lender, will rate each of those 3 loans by themselves. The scale is a 1 to 8, 1 to 9, 1 to 10. Like a 3 is like a 3 or 4 is like an average loan. A 5 is a watch, or
So your
there's
risk
some
rating.
issues.
You're talking the risk rating.
Risk
Okay.
rating.
Okay. Yeah,
Risk
yeah,
rating.
okay.
So you've got a 3 or 4 is an average. A 5 is a watch list. A 6 is substandard. Woo, there's some major issues. A 7 is doubtful. An 8, loss. Individual commercial loans are risk rated individually. Does that now make sense, Kirk?
Yeah, I wonder what mine is.
Now, you could ask your lender, but they may tell you, but they may not. Yeah, if your pain is agreed and I'm going to guess you're probably a 3 or 4. You're an average, or sometimes called standard, usually just an average loan. But if you've had some hiccups, some problems, you're maybe a 4 or 5. If major problems, a 6. Major, whoo, you're slipping down. What I'm saying
you said most often the consumer loans are usually risked by the type of loan it is?
Yes. Most consumer loans, Michelle, it's just the whole batch of auto loans are like 3 or 4s. Now, of course, if the individual loan starts to deteriorate, like we saw in our case studies, then of course that individual loan would go from, like, say, a 4 down to a 5 or even a 6. Does that make sense? But,
yes.
But what I'm saying is, the bank traditionally doesn't spend as much time loan risk rating the individual auto loans. No, it's just a group of loans. Whereas the commercial loans are big enough that the loan officer individually, or the loan officer has to individually review and give a rating to each of those loans. Does that make sense?
Yes.
Okay. Michelle, makes sense? Okay, good.
I bet I'm a 1 or 2, by the way.
Pardon me again?
Oh,
I bet I'm a 1 or 2.
superior, high quality. There you go.
Whoa. Portfolio management. All we're saying here is, from a management standpoint, your bank manages, or Kirk, your client banks, they manage their portfolios: consumer, residential or mortgage, and commercial. From the risk rating, but also even the type of loan. All the auto loans, all the RV loans, all the HELOC loans. From a commercial lending, they'll also manage, all the lines of credit, all the equipment loans, all the CRE or commercial real estate loans. Even though they're individually rated under Part B, they look at the portfolio and manage accordingly. Questions on that? Questions? Okay. In conclusion, consumer lending is vital to the bank. What's great about this session, and I want to thank both of you, is we went beyond just normal consumer lending. Boy, mortgage, commercial, multiple aspects of bank lending. This was great. Now, in conclusion, I'm going to have both of you do a quick activity. On this page, at the bottom of this page, towards the bottom, middle or bottom, go back in the material, go back in the PowerPoint. Take just a moment on this. What are 1 or 2 takeaways from today's session? What are 1 or 2 takeaways from today's session that will benefit you? There's no right or wrong to this. I'm not looking for a magic answer, not looking for something, whatever, just 1 or 2 takeaways. It could be a major model like the 5 C's of credit. It could be just one little concept of one of the major models. No right or wrong to this. What are 1 or 2 takeaways? That will benefit you personally? No right or wrong to this. What are just 1 or 2 concepts we covered? We covered a lot. We covered the marketing. We covered the 5 C's. We did the whole panoramic of the consumer lending process, including the collections. Well, we even did the documentation extensively, collections, a lot of these. And then we did our case studies. Those case studies are the main part where we really pull it together. Decision-making, which quite frankly, some, especially newer lenders, they don't want to do those case studies. Don't make me make the decision. Well, that's what you're going to be doing in lending as a lender. You've got to make the decision. Okay, here we go. Michelle, would you give us your 1 or 2 items, please?
My number 1 was the case study and examples. I'm very much a good learner that way. It helps put things into perspective. That was my number 1. The number 2 was the right of rescission example that you made, because I'm here to tell you that's one area I don't do a lot of work in, is in mortgage, because it terrifies the crap out of me. And luckily my lender doesn't do many of them, because I'm always worried about all the little rules.
Good.
And with that one case study, it made it opened up some eyes a little bit.
Good. Excellent. Thank you. Kirk, how about you? What's one of your 2 items?
I would say probably the biggest impact is probably just over the years, how the DTI has changed from higher percentage of net or lower percentage of gross or vice versa.
Yeah.
And then the most HELOCs are based on prime, not LIBOR.
Good. And by the way, LIBOR, which stands for London Interbank Offered Rate, for not to go too deep on this, is going away. The migration in the banking industry is to SOFRs, Secured Overnight Financing Rate, SOFRs, SOFR, Secured Overnight Financing Rate. For whatever reason, the industry is moving. Now, prime is still the main interest rate for commercial loans and variable, it's variable rate, of course, but larger commercial deals and some consumer deals have been based off of LIBOR, but that's going away. It should have already been gone away, but with COVID, my observation with COVID kind of delayed the transition to SOFRs. It's a different index. Good point. Good. Well, with that, I want to thank each of you for attending today's session. As we started out, please do not hesitate if you've got a question on any of this material we covered or anything to do with lending, once again, we did more than just consumer. We did, mortgage, we did commercial, everything. Please send me an email. I'll work with you. Thank you, both of you. This was not just excellent. This was superb participation. Seriously, this was excellent. Thank you both. Have a good rest of your day and a great weekend coming up. Thank you so much.
Thanks for your time today.
Thank
Appreciate
you.
it.
David, thank you.
Thanks,
Thanks,
David.
everyone. Michelle,
Thank you.
Kurt,
And
Thank
Thank
you.
you so
Michelle and I-
much.
Michelle and I will not forget that there's no E at the end of your name.
I love it. I love it. Kirk, also, I've got to say this. The humor today was excellent. That was great.
Not
Thank
bad
you
for an
so much.
engineer.
Thank you,
Yeah,
Stephanie.
especially for an engineer.
Oh, that's
There you go.
true. That is so true. I don't know. I got to say this really quick. Kirk, Michelle kind of alluded to this earlier, but you're not the typical engineer personality. I love it. Thank you, everyone. And thank you, Stephanie, for being our administrator.
My pleasure. Thank you so much.
Have a great
Thanks,
weekend.
everyone.
Thank you.
You
Bye.
too.
Bye now, everyone.